Alongside Madison Mills this morning, this is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. Stock futures feeling some pressure this morning, a weaker than expected reading on the manufacturing sector, pushing major averages lower. The data weighing on market sentiment and the Fed's path forward for rate cuts.
Plus, a fresh read on the labor market. The latest data on unemployment, layoffs, and job openings is set to be released at 10 a.m. Eastern. Investors looking for signs of a resilient labor market ahead of this Friday's critical jobs report. So let's get to it with the three things that you need to know this Tuesday morning. Your roadmap for the trading day. Yahoo Finance's Inez Ferre, Dan Halley, and Jared Blickery have more.
Oil prices slide to a 4-month low as OPEC Plus's output decision comes across bearish. The Oil Alliance agreeing to extend most of its oil reductions into 2025 in a move to support prices. But analysts are concerned the phase out is premature amid concerns of slowing demand going into next year.
Plus, AI chip wars are on fire. Intel, the latest to announce a new processor out of the Computex conference in Taipei, Taiwan. The Xeon 6 is designed for data center applications and is meant to give Intel a boost next to competitors like Nvidia and AMD, which also unveiled their own chips at the event.
And we're also taking a look at a possible ban on Roaring Kitty. Keith Gill, the man better known as Roaring Kitty, who ignited the 2021 meme frenzy, is at risk of having his account banned on Morgan Stanley's E-Trade, and that's according to the Wall Street Journal. This comes after Gill revealed he spent nearly $175 million building a position in GameStop using the E-Trade platform, raising concerns over potential market manipulation.
Well, our top story, trading for the month of June, off to a slow start. Futures are in the red this morning as we're taking a look at the Dow futures right now, down by about 0.2%. The Nasdaq 100 futures lower by about 0.2%. And the S&P 500 futures also lower right now here. And this is, of course, coming on weak manufacturing data, causing investors to fear a downturn as the Fed weighs its path forward on rate cuts here. As we've made it through the lion's share and really the majority of the earnings season, a few companies trickling out here and there. We're going to break those down for you in just a little bit, so stay tuned for that, especially if you're into fragrant candles. But at the end of the day, one of the huge things that we're going to be watching over the course of this week as well, and the setup to today's trading activity as we're taking a look at some of that sector activity coming into the start of trade here, is going to be where the economic data, especially on payrolls, jobs, that continues to move the Fed's thinking, or at least what the market's anticipation of the Fed's thinking might look like.
Yeah, absolutely, Brad. It's really interesting to see kind of the market movement, particularly yesterday, right? We saw a little bit of a sell-off after that soft data that we saw from manufacturing. And then, of course, the last 10 minutes of the trading day, the most important, we saw a little bit of dip buying activity. Taking a look at what we're seeing in the tech sector prior to the open, at least, we are seeing some of the big names getting a little bit of pressure. So that's likely to be something that's going to cause some pressure on the overall index, particularly the Nasdaq as we head into the open. But we're also seeing a little bit of a sell-off in the Treasury space as well. So an indication that this market confused like all of us about when the Fed is going to be cutting back on rates. But also looking at the oil market, crude oil sliding to a 4-month low today. This is coming after OPEC agreed to extend most of its oil output cuts into next year, still leaving room on the table for members to roll back voluntary cuts coming up in November. Now that is earlier than a lot of analysts who had spoken with us had assumed. So for more on this, we've got Yahoo Finance's very own Inez Ferre with more. Inez.
Yeah, Madison, and OPEC Plus is agreeing to extend most of its oil production cuts into 2025 in a detailed plan. However, the Oil Alliance said it'll begin unwinding some additional voluntary reductions starting in October. Now, that's what primarily has sent the oil market spiraling down yesterday and today, with some analysts predicting that unwinding any cuts this year would be bearish for oil prices. Weaker than expected ISM manufacturing data, as you guys just mentioned at the top of the show, has also raised concern about the resiliency of the U.S. economy. We're off about 13% off the April peak from oil prices. We're still positive for oil prices this year, but we have seen a downward trend in those prices. And the expectation is that if OPEC Plus starts phasing out these cuts, these voluntary additional cuts, which is about 2.2 million barrels per day of additional voluntary cuts, if they start to phase them out monthly starting later this year, you could see an oversupply. So there's concerns of oversupply in the market coming at a time where demand is we're not sure where demand will be by the end of the year, guys.
All right, you've been all across this one. Thanks so much, Inez Ferre, for tracking it and bringing the latest on that. All right, the chip war, we're also tracking that this morning. The chip war is heating up. Intel shares, they are moving higher pre-market after announcing a new data center chip. Now, the unit is designed for high-performance computing for AI data centers and introducing an AI accelerator as well. Intel has been lagging far behind some of those chip maker competitors like Nvidia and AMD. Intel's new products, though, are they enough to take some market share from the chip giants? To break it all down, we've got Yahoo Finance reporter Dan Howley here with us, our tech DH. Dan, what do we know about this? And is it significant enough for Intel to take some market share?
Yeah, Brad, these are kind of, the announcements have largely been telegraphed. We have the Xeon 6, that's the data center chip. It's not necessarily an AI accelerator like what you would get from Nvidia or AMD. It's really an all kind of purpose chip. It's a high performance computing chip rather than something that would power, say, generative AI. That's still very good. This is something that, servers still need these kind of CPU chips. So this is a big announcement for Intel and for the industry. On the AI side of things, where all the hype is, they announced their Gaudi chip pricing, which they say is going to come in less than what you would see from Nvidia or AMD, presumably. They didn't say exactly who, just competitors vaguely. But still, the fact that you would be able to purchase a competitive chip at a price that's lower than what you would have to pay for the likes of Nvidia or AMD is important, because those chips go for tens of thousands of dollars. So those are sort of the big deals that are coming out of Intel on the data center side. They also announced their new Lunar Lake chip. These are for consumer and commercial PCs, laptops and desktops, and they say that this is basically a chip that will be able to compete with the likes of ARM's chip line, the Qualcomm Snapdragon X Elite line. Those chips are basically designed to go ahead and rival what Apple has managed to do with its Macs, which is build power and performance. So long battery life and strong performance into a chip, something that was really lagging on the Windows side. So Qualcomm went ahead and did that with their ARM-based chip, and now Intel says they're doing the same thing. And oh, by the way, AMD also announced its own new AI accelerator roadmap, as well as chips for laptops and desktops and AI PCs.
So Dan, talk to me about the customer that Intel is targeting and how that differs from Nvidia's. I know they talked a lot about enterprise customers here. Is that an area that they see a stronger use case for in terms of gaining market share from Nvidia?
Yeah, I think really the hyperscalers are, the Microsofts, the Googles, they're all in on Nvidia at this point. They offer competing chips as well, just because their customers want to have some kind of option when it comes to the types of chips that they may want to take advantage of when they're building out their AI platforms. But this will allow for other companies outside of hyperscalers to get into generative AI at a potentially lower price. And I think that's something that's worth acknowledging. It's not just the hyperscalers, it's not just the Microsofts, the Googles, the Amazons, the Metas, the Teslas, what have you. It's healthcare, it's individual research institutes, it's automotive industries, and so that's where we could see Intel really shine. They also, their AI accelerator chip is going to pair nicely with the Xeon 6 chip, just because they'll have the compatibility because they're from the same manufacturer. And so I think that's something that Intel also has. As far as market share goes, look, Nvidia is still the odds-on leader in the space. They know what they're doing. They've been doing it for a long time. They have the software and the hardware. They have that moat that they've built up that's going to take a while to get companies to break through. I don't think it necessarily means that we're going to see significant market share improvements from Intel, but they'll still, gain some. But this isn't a, knock Nvidia off its throne kind of thing by a long shot.
All right, Dan, we got to leave it there. Thank you so much for joining us on All Things Chips. A lot of news on your beat this week and always, so we appreciate it. Thanks so much. Now, meme stocks seem to be losing steam after shaking up Wall Street on Monday. The latest round of GameStop fervor kicking up again when an account believed to be tied to investor Keith Gill, he's the guy who ignited the whole meme stock rally back in 2021, revealed that it spent nearly $175 million building a position in the video game retailer using online trading platform E-Trade. Since that post, there's now ongoing discussions at Morgan Stanley's E-Trade to ban Gill's account. That's according to the Wall Street Journal. Now, this raises the question of whether or not more companies need to be on the lookout for how social media is impacting trading. Here to weigh in, we've got Bill Capuzzi. He is CEO of Apex FinTech Solutions. That is a digital wealth management company. Bill, thank you so much for being here with us. I mean, as I mentioned, E-Trade is considering blocking Keith Gill from the platform amid growing concern about stock manipulation. Would you consider the same?
Yeah, look, when I looked at the facts that I can see based upon what Keith has done, really there's no reason to be banning him from their platform. I think it's actually a black eye for Morgan Stanley to take this position, right? It's no different than someone like Warren Buffett putting out sort of 13F filings for Berkshire Hathaway, in that obviously a smaller sense in the case of Keith Gill, but he's basically put out his positions that he owns. He's published them on social media, and it's obviously created some stir in the market. But from an outsider looking in without seeing all the facts, I don't see anything wrong with what he's done.
And so as we're taking a look at the update that came through yesterday that was posted online, I mean, this comes back to what had taken place in some of the proceedings on Capitol Hill when there was a lot of fact-finding in the wake and the aftermath of the height of the meme stock frenzy in January of 2021, where then elected officials were trying to figure out, okay, how is it different for someone to go on social media and just post what they might talk about at a backyard barbecue in their holdings and their positionings and what they're invested in and, what their strike dates might look like, all of those things versus what Wall Street has been known to do and firms have been known to publish for years, and the difference there. Is it any different than what was already found out at that time right now?
Yeah, look, first of all, the environment is incredibly different than it was in 2021, right?
Sure.
What happened back then, right? Let's just take GameStop. It was called a hard to borrow, right? So there's a big short squeeze, and part of the reason for that was that there weren't a lot of shares to borrow to cover the shorts, all right? And it caused challenges. Number one. Number two was we were settling trades in what was called a T+2 environment. So you settled trades 2 days later. Last week, we moved to T+1, which definitely changed the environment in terms of trading. What it means is that I buy or sell something today and tomorrow it settles, right? And it creates a better environment for us, right? It creates a lot less risk for the entire street. Specific to his trades, to your point, Brad, it's no different than an institution filing their 13F filings, right? In terms of what he's doing, there is a fine line. It's if they're posting on social media, hey, this is what I'm doing, right? Having the position after, right, and causing manipulation in the stock, that obviously is illegal, right? But from what I see in terms of Keith Gill, I don't see any issue, right? And frankly, we would invite him onto the Apex platform. Based upon the facts and circumstances that I see, right? He's expressing his views in terms of what he thinks, in terms of GME, AMC, some of the different meme stocks. I don't see any issue with what he's doing.
Well, Morgan Stanley would say the issue is that, they would likely say that the issue is the call options prior to posting. To what extent do you think that is a valid argument?
I mean, he bought call options. Right. So again, he's expressing his view. What I love is the fact that we've lowered the barriers and allow for retail investors to use things like equities, like options, to, again, express their views. He had bought these options and he actually took a post and said, hey, I have these options on. Right. There's nothing wrong with that. It's, again, make the analogy to Warren Buffett or to any other institution as to post 13F filings. They're telling you what their positions are. Right. There's nothing wrong with that.
Well, Bill, you said at the beginning of our interview, you called this a potential black eye for Morgan Stanley if they do, in fact, block him from the platform. How likely do you think E-Trade would be to lose other customers if they make that move?
Very likely. All right, so let's go back to 21 and then fast forward to today, which is amazing for our industry, is retail investors have power, right? That we've lowered the barriers, folks like Apex, creating a platform that allows for people with small amounts of money. This is not a rich person's game anymore, and effectively allow these people to access the market. And so my sense is that if they kick him off the platform, for sure there's going to be backlash from Morgan Stanley E-Trade in terms of others saying, hey, this isn't fair. He didn't do anything wrong as far as what we see. Again, I don't have all the facts, but based on what I see, I don't see anything wrong with what Keith Gill is doing.
Bill Capuzzi, who is the Apex FinTech Solutions CEO, joining us here. Bill, great to see you. Thanks for hopping on.
Good to see you. Thank you.
Thanks. Well, we're just getting started here on the Morning Brief. Bath & Body Works investors, they're not loving the first quarter report. Not smelling great. Shares sinking this morning. We've got the details next. And the battle of the chip giants heating up. We'll speak with an analyst who now has the highest Nvidia price target on the entire street. That's coming up later on this hour. Plus, we'll get data that could give us more insight into the state of the economy, the latest job openings, jolts. Yes, we've got more on that during our 10 a.m. hour of Catalysts. All this and much more. You're watching Yahoo Finance.
We have some breaking news this morning. Elon Musk is reportedly ordering Nvidia to prioritize and ship thousands of AI chips meant for Tesla to X and XAI. That is according to emails obtained by CNBC, but we know from Tesla's first quarter earnings call, Brad, back in April, Elon Musk saying that the EV company would increase the number of active H100s, that's Nvidia's flagship AI chip, from 35,000 to 85,000 in number by the end of the year. But emails that CNBC obtained from within Nvidia, from among staffers shared within the company, suggesting that Elon Musk could have exaggerated that number, that 85,000 number, in terms of the number of chips to ship to Tesla in his statements to shareholders. And now, of course, the big news that he could potentially be diverting those chips to X and XAI.
I mean, this is amazing, considering the fact that we've already heard Jensen Huang be very rosy, at least in his interview with Yahoo Finance, about the work that Elon Musk is doing at Tesla, talking a smidge about XAI as well there. And for XAI, I think as they're continuing to try and get a grasp of how many chips that they'll need in order for artificial, I mean, think about the data centers. It's 60,000, I think it was, we had a guest on yesterday, Beth Kindig, who had pointed to a $10 trillion valuation one day that Nvidia could get to. And it's on the back of growth in the data center as well, where Jensen Huang is talking about a data center that could have 1 million chips in it. And so 60,000 chips as of right now is what they're already talking about. So all of these things considered, XAI is going to require, and artificial intelligence as a whole is going to require a ton of chips in these data centers in order for them to be able to have the compute power to process and have the inferential kind of connectivity of all of these troves of data. That's really only going to be multiplied when you think about the number of interactions that are going to have to take place with AI that only add on a significant multiplier, or even, I mean, my goodness, like it's just, it's mind-blowing almost at the end of the day.
Yeah. No, it's such a huge story, and I think that's why, I mean, we initially did see Tesla's share price drop 1% on the news, which I think just goes to show that, to your broader point, Brad, this is such a big deal for markets in terms of what we're seeing from company demand for chips. Anything related to Nvidia within each individual company is going to move potential stock.
Exponential is the word I was looking for.
Exponential, there you go, Brad. Great word of the day. Well, we're going to move to another company here, because Bath & Body Works shares are sinking this morning after its second quarter sales forecast coming in below expectations, now expecting a decline of 2% to flat moving forward. Now, the company did slightly boost the bottom end of its earnings guidance for the full year, but we all know we're always looking for that top line number for these companies, and they did not deliver on that top line number. That is why we're seeing Bath & Body Works down over 7% in the pre-market trade here. They, again, had better than expected results across the board, but their Q1 outlook was spooky for investors, and we're seeing shares down off of that. Their net sales were also down. We're seeing nearly 8,000 call options on this name ahead of the market open, Brad.
Yeah, it kind of stinks, honestly, and here's why. You look at the broader environment, from the amount of people that are spending into little luxuries right now. That scented candle, little luxury. That added, hair wash or any of the kind of body gels that you might be using, a little luxury that people are tapping into. You're hearing success in parts of other businesses, and Bath & Body Works is signaling in its outlook that it's going to be weaker than expected. That's not good for shareholders who are trying to evaluate, okay, if a consumer is spending into this, that means that they're trading away from your brand right now, especially if other companies are saying something that is counter to the guidance that you're putting out as of this time. So all of that in mind, putting a little bit of a number on this, they said it was a strong start to the year. Pleased, though, to narrow their full-year guidance range while raising the midpoint for the top and bottom lines. So it's going to be interesting to see how they meet that and where ultimately some of the consumer sentiment shifts towards when you're spending into the little luxuries of everything from body scrubs to facial oils and I don't know, whatever makes people's self-care Saturday come to life.
Well, it's a great point, and I know you talk about this a lot on your show Wealth as well, right? It's this idea that consumers are starting to struggle, particularly on the low end, and a Bath & Body Works is a more economic brand, so it's not really that surprising when you see this stock struggling a little bit today, Brad.
Absolutely. All right, well, from soaps to screwdrivers, shares of Stanley Black Decker moving lower this morning after Barclays downgraded the stock to equal weight from overweight. The analyst behind the downgrade saying the current trading levels are too high to be justified. Meanwhile, U.S. imposed tariffs on Chinese imported products could also hurt sales. We're taking a look at the shares. They are down by about 1.7% here this morning. And it was an interesting call that came out from Barclays here this morning, and downgrading the stock from to equal weight from overweight. And then additionally here, one of the huge things, the sluggish sales, likely to be a key headwind to the rapid EPS growth that was predicted here.
Yeah, this implies a 1% drop from Stanley's current market value and level. And it's another example, right, of what we're seeing in terms of consumer behavior having a negative impact on some of these names. You can see year to date, the stock is down over 11%. And that makes a lot of sense when you consider that the housing market is sort of in a standstill right now as interest rates continue to be higher for longer. People are staying in their homes longer. It's the same thing that's impacting some of the companies like Lowe's, Home Depot. These other home renovation related names are having a negative impact because of people staying in their homes for longer. There's just not a ton to be done in the tool buying space for all of your home renovation needs.
Yeah. What is the tool replenishment rate? I honestly
Right.
don't know.
You don't want a business where you only need to buy it once in your lifetime.
I
Right?
mean, I've had the same screwdriver for the last 4 years here. So
I'm impressed that you own a screwdriver. I don't own a
the power one, you gotta have it. You gotta have a power one.
I don't own
You
tools.
You just have to.
Bad.
Yeah, it's gotta be portable too. Mine plugs in, unfortunately. I'm working on that.
that's
Boeing. Yeah, let's talk about them this morning. Boeing. I was tracking this one. You were through this morning. Boeing has had a difficult start to 2024. Shares down nearly 30% so far this year. The company's CEO Dave Calhoun speaking at an event in Berlin, saying Boeing is a, quote, different company post the Alaska Air incident, but that it's looking to put the crisis behind them. Now, Calhoun, he's also going to be putting Boeing behind him. He's set to step down from his position by the end of the year. Of course, they didn't go into who might be the leading candidate just yet. A lot of questions about who is going to be the right person to steer this aircraft behemoth. He also talked about how many different businesses that they do operate. Of course, a lot of people know them as, and he was kind of putting it as, we have the connectivity, and that connectivity is essentially how they're getting people from point A to point B. That's obviously what people know. But then there is, even on the military side of the businesses that they do have in terms of defense and so forth. But I think it's really just a matter of where within the operational changes and how they're lifting up the rug in certain parts of the factory floor and their own manufacturing operations, where they are lifting up that rug and continuing to see traces of what was previously determined to be negligence and now has really kind of become even more of a focal point on what the corporate culture was. And so getting rid of the bad apples that were kind of rotting some of the operational the operations at the end of the day. I think that's what's going to be key here in how they're able to deliver aircraft going forward as well, and what airlines should be expecting in taking delivery.
And investors keenly watching the succession plan, of course, is going to be critical. Now, he did have just an interesting mention. He said regarding U.S. isolationism moving forward, he said he doesn't like any of the signs that he is seeing on the U.S. becoming an isolationist nation, particularly with regards to the impact it could have on free trade and the economy moving forward. So interesting to get executive takes on what we're seeing more broadly with trade, as well as that kind of tends to heat up as we get closer to elections. Speaking of things coming up, we are just minutes away from the opening bell on Wall Street. We're going to be watching the day's biggest market movers ahead of the key jobs data coming out right here at 10 a.m. That's coming up later, so stick with us for more.
Hey, we're tracking the opening bell here. We are the morning brief brought to you by Invesco. And let's do a quick check of the markets here. I thought we were going to have a look at the NYSE, but let's take a look at the Dow Jones Industrial Average here to begin things. As of right now, we are lower by about 0.3% out of the gate. The Nasdaq Composite flat just barely to the downside here. Still net positive for the past 2 days. And then the S&P 500, you're seeing that moving lower by about 0.2%. Let's fire up some of the sector activity as we're just taking a brief look at the 11 S&P 500 sectors. This is the past 2 days. Let's give you an intraday look so you get an active view of what's taking place out of the gate this morning. Really, the only gainer right now, Staples.
Yeah, it's interesting to see that we're continuing to see this kind of risk-off sentiment. I was noticing that the S&P equal weight index, and now we're flipping just across the board into negative territory. We're seeing that maybe there's a little bit of broadening happening. That's why the S&P is at the flat line, the S&P equal weight, whereas we're seeing the broader S&P index chipping into negative territory, which is likely to continue as we head further into the opening bell here. But we are going to get more insight into that with Yahoo Finance's Jared Blickery. He is watching what is moving in the markets for us at our big board. Jared, what do you have for us this morning?
Thank you, Maddie. I wanted to take it, and let's load the Wi-Fi Interactive here. We just got off a very positive May, and Ryan Dietrich crunched the numbers, so this is kind of a bigger picture view. We just had the best May of the S&P 500 in 15 years, and then if you look at the 10 best Mays and you look at the results, the rest of the year happens to be up double, 10.5% versus 4.9%, and June is up 1% versus an average negative. So June usually has a little negative seasonality there. But with these strong gains, the conclusion, as I like to say, is that strength begets strength. Now, I want to take a look at the dollar and also the 10-year T-note yield because both have been under a little bit of pressure recently. Here's a 2-month look, and you can see the U.S. dollar index just after bouncing up a bit after a string of losses. But I'll show you that this happens to be an important support area, and here's a head and shoulders top. If we break below, should gain some momentum, and that would be a tailwind for stocks. That lower dollar, that tends to help risk assets. Here's a 10-year T-note yield, and that is falling as well. But here's one thing that I've been checking out. If you take a look at what's happening with commodities, and I don't need to rehash WTI crude, Ines is on that beat, but commodities in general have really just fallen off recently, and that has to do with the deteriorating economic picture. We've gotten some weak manufacturing numbers, and so that's at play there. So then if the soft landing isn't in play and the no landing is, then you got to think about possible hard landing. So I think that would be the next pivot, but that's probably a bit farther down the line. And here we have the sectors opening up mixed for the day. Energy, the biggest loser here with crude oil now down below about $78, $77 there. Real estate, the only sector in the green. And let's briefly check out what's happening with the Nasdaq. And here we have a mixed board, but Nvidia, this looks like it's going to be another record high. Here's a 4-day look, and yes, indeed, exceeding the highs from yesterday. So another record high for Nvidia. Surprise.
Surprise, surprise, as always. Jared, thank you so much for joining us and breaking down all things markets for us. Now, major indices are on the move to the downside, seeing a lot of red across your screen, across the Dow, the S&P, and the Nasdaq. The S&P kind of furthering its moves to the downside, down about 0.3% as we move past the opening bell. We're going to get a pulse on the labor market at 10 a.m. with the latest report on job openings and quits. Manufacturing data earlier this week showing a contraction over the course of the last month. Our next guest here thinking that there may be some cracks in the economy. So for more on this, we're joined by John Lynch. He is Comerica Wealth Management's Chief Investment Officer. Thank you so much for being here with us, John. I mean, let's talk about the extent of these cracks. 2 weeks ago, I feel like we were celebrating better than expected PMI data. Now here we are in this kind of, oh no, are we heading towards a recession? The GDP now figures dropping situation. Are we overreacting or had we previously been underreacting?
Well, good morning. And I do think we're overreacting currently. You know, we're seeing some weakness, obviously, in manufacturing. That's persisted. We have been creeping higher, but yesterday's report was disappointing. I think the services number tomorrow will be very important because when that cracked last month, that really kind of got everybody's attention. But I really think it's important for investors to focus on the fact that we saw durable goods orders up. We've seen claims really strong. I'm surprised to see what I would characterize as too much concern about Friday's report. You know, if businesses are spending on labor and if they're spending on capital, which is again evident in the weekly claims data, which is more current, and certainly the durable goods orders, you know, I think we're going to see basically in line with unchanged, if you will, from last month, looking at maybe 180,000 jobs created on Friday.
So how many more reports and you can kind of take your pick of the economic data piece that's really going to move the Fed's mind one way or another? How many more reports are they going to need to see in order to feel like a trend is locked in towards their goal?
Well, I think they're going to have to see a while. And, the messaging is very clear for an institution that prides itself, as Mr. Greenspan used to say, obfuscation. Looking at the inflation data, year-over-year core is still 2.8. Now, we can round all we want, but it's hard to get to 2% when year-over-year core is 2.8%. So I think they're going to hold off. I still think we're going to see, call it mild strength in the jobs data. So consequently, I believe the Fed is on hold until at least September.
Well, talk to me about what could fuel those rate cuts coming up. I mean, we are seeing about a 50-50 chance of a rate cut in September priced into the market right now. Something like the meme trade that we're seeing right now feels like it might come up to members of the Fed as a potential concern that means there's too much liquidity. Is that something you think will be at the top of their agenda in making that decision, or will it be more of the data?
No, I would separate the meme trade from the jobs data. To get the Fed to cut rates will have nothing to do with the meme trade, in my opinion. I suspect a couple of months of extremely weak employment data. As we all know, the Fed has a dual mandate, but they've been focused solely on inflation for the past couple of years. So if you see a crack in employment, a significant plunge, I think that would be enough. I know some people are talking about a July, looking at Fed fund futures. I think that would be, if you saw really weak May and really weak June data, that could necessitate a July cut. But on the meme information, I think it's more important on the meme stuff, the meme stocks, to really look at what Treasury is doing and the whole liquidity environment. People don't talk enough about the fact that M2, right, the money supply, is still up by a third from where we were pre-pandemic levels. So that's an additional $5 trillion sloshing around the economy. We've seen, even though the Fed has enabled or allowed $1.5 trillion to roll off its balance sheet over the last 18 months through reverse repo programs, through drawdown in the Treasury general account, Treasury's provided the equivalent of $1.5 trillion, essentially offsetting the Fed's quantitative tightening program. So that extra liquidity feeds its way into consumers, businesses, and risk assets.
While we have you here, we have to talk about Nvidia. I mean, we've seen tech and chips dominate the market this year. I mean, it seems like, that is the way into a conversation, even at, people's backyard events over the course of this summer. We just got to talk about this Nvidia. Where do you see the sector going from here? We got a new fresh all-time high at the opening cross here for the company, too.
It's fascinating, Brad. I'm glad you brought it up because, your earlier segment talked about Elon Musk requesting an additional 60,000 chips or whatever. What's 60,000 chips if you're looking at some of these data centers in the future that may require 1 million chips, as you highlighted? So I really think, looking at tech, looking at, the semiconductor space in particular, I like to look at relative performance within a sector. And to the degree people may be concerned about technology on valuation, I still see the semiconductors outperforming software. And I think that really bodes well, not only for Nvidia, but we see this morning that Intel's coming out with the new laptop chip. AMD is coming out with new AI chips. So it's broader than Nvidia, even though Nvidia is the household name.
I keep asking this. I am just curious, which Jay matters more, Jensen Huang or Jay Powell? Because we continue to see that Nvidia drives this market forward. Even a day like yesterday, we saw a bit of a sell-off, and then the last 10 minutes of the day, a bunch of buying the dip, because why not get in when Nvidia is at a little bit of a discount? What do you make of that?
Well, as exciting as Nvidia is, I have to give the J to Jay Powell because, at this point in the cycle, there was a lot of concern about where we are with seasonal weakness, but with the markets heading into a typically seasonally weak period in an uptrend, history's shown that we tend to perform favorably, and those are our expectations. But it's really about earnings and interest rates. Despite all that liquidity out there, Powell still holds the levers that I think will keep this market going, and I suspect he's going to be on hold until September.
John Lynch, Comerica Wealth Management Chief Investment Officer. John, great to see you, and thanks for joining us this morning.
Thank you.
Thanks. Coming up, the battle of the chip giants. We'll speak to the analyst who now has the highest price target on the street for Nvidia. That's next.
Welcome back to Morning Brief, brought to you by Invesco. Now, the battle of the semiconductor space heating up with Intel, Nvidia, and AMD all announcing new next-generation AI chips. But we're going to zoom in on Nvidia. It's already been a huge year for the stock, obviously. Shares, though, up over 130% so far just in 2024, surpassing that $1,000 milestone for the first time a few weeks ago, and just this morning hitting another record high. But it hasn't just been this year, right? Nvidia's dominance sending shares skyrocketing over 500% in the last 2 years. Take a look at that extreme climb there, and that coming as investors double down on AI hype. All of Nvidia's momentum leading to a lot of bullishness across Wall Street. Bank of America becoming the latest, hiking their price target on Nvidia this week from $1,320 to $1,500. This is now the highest call on Wall Street for the chip giant. The analyst behind the call, Vivek Arya, is Bank of America's senior semiconductor analyst, and he joins us now. Vivek, thank you so much for being here with us to talk about your bullish call on Nvidia. I'm curious, why 1,500? Why not doubling your price target on this name, considering the amount of bullishness and the fundamentals that back it up?
Sure. Good morning. Thank you for having me. So I think there are two aspects to it. The first is where we are in the cycle of converting data centers to accelerated computing, right? The concept of the data center is not new. It's been around since the 1940s. But then we have these multi-decade infrastructure upgrade cycles from the mainframe to the microcomputer to cloud computing. And now we are at the start of what I think would be a decade-long conversion over to accelerated computing. What is accelerated computing? It's a way of taking a lot of very intensive data processing tasks that have to do with images, with voice, with video, with the processing of these large language models, and converting the data center with new kinds of semiconductors to make sure that processing can be done very efficiently. We are just at the start of this cycle. We think that the spending could be anywhere between $250 to $500 billion a year, and NVIDIA is leading the charge. And I know there is often this comparison to let's compare it to Intel of the past, or let's compare it to Cisco of the past, or other parts of the technology upgrade cycles. But what is different is that NVIDIA is bringing a combination of silicon, of systems, of networking, of software, of developers, and that is unprecedented. So to come to your question, technology stocks, the price targets really move because of the size of the market, because of their execution. And even at this $1,500, the stock would essentially be trading at 1 times their earnings growth rate. If you look at the S&P 500, it's trading at 2 times their earnings growth rate. So I would claim that even at this kind of price level, it's actually trading below where the broader market is in terms of the price to earnings to growth ratio.
High target on the street for you, Vivek, for NVIDIA. What is the significance that you see in deals like the one that is being reported this morning? XAI potentially going to be taking the chips that Tesla was supposed to be getting from NVIDIA here.
Yeah, I think there is a race going on between technology companies of various types. We have seen that across the cloud players, who have raised their capital spending forecast to over 40 to 45% growth. Last year, we were thinking that growth would be 20%. It's already 40 to 45%. There is a race between these different technology companies to be the first to support the next large language model, to make sure that they are the destination of choice for a lot of startups who are trying to really kickstart their own generative AI applications. And then this market is broadening from these cloud service provider to a lot of enterprise verticals. And in this most recent quarter, NVIDIA did call out that automotive and automotive customers, which I assume includes Tesla, are part of that really large vertical. So we see this spreading from cloud customers towards automotive, towards healthcare. A lot of drug discovery is being done with this infrastructure. Financial services are benefiting from it. And then the last but not least part that we will start to see more is the rise of this infrastructure among sovereign, right? So we have seen India, Europe, Japan, every country and region, the Middle East, they are trying to make sure that they're able to use their culture, their language to really go and train these large language models. And we think we are just at the start of and that could be a really large infrastructure upgrade cycle as well.
Vivek, you mentioned customers, and it makes me think about Intel's latest chip announcement, and the executives really speaking about this idea that their chips are not necessarily for the hyperscalers, they're for more of the enterprise customers. They're going to be a little bit more affordable. To what extent do you see that as a winning strategy for Intel moving forward, particularly given the amount of headwinds facing that stock over the course of the past year here?
Sure, absolutely. I think we have to give Intel the credit that they have very strong enterprise incumbency. They are the brand name, one of the most trusted names in enterprise infrastructure. But broadly speaking, Intel is facing this challenge where they have been behind in AI. They have the incumbency, but they don't quite have the deployed base, the range of software developers. So for example, NVIDIA has 5 million developers on their CUDA platform. So a lot of the enterprises, as they start to look towards their AI infrastructure, the first name they turn to is NVIDIA, for the reason that there's a lot of developers who are already familiar with NVIDIA's infrastructure. And number two, as these enterprises start to scale out, they look towards cloud instances. And that too is where they find a lot of NVIDIA-based instances. So broadly speaking, if I look at the overall AI chip market today, we think it's about $100 billion or so this year. NVIDIA is about 80% of that. Custom chips from Broadcom, Marvell, and others are another 10 or 15%. And then you have this long tail which has AMD, which has Intel, which has a number of startups. And even as that look forward over the next 3 to 5 years, as this market doubles or triples from here, we think that ratio will stay relatively in that range, that NVIDIA will continue to have 80%. We think custom chips will have another 10 or 15%, and then you'll continue to have this long tail of companies that have a presence. They benefit from the rising tide in this market, but they're never quite able to achieve the escape velocity that the leader in the market has. And by the way, that is not too uncommon. If you look at other parts of technology, search, social, e-commerce, operating systems, you see the leader that has the early start, that has the scale, the incumbency, the relationship with developers, claiming 80+% of the market. And we see exactly the same thing in the AI chip market as well.
So what would change that dynamic moving forward, Vivek? And I would love to get your answer on that in the context of some of the cloud providers that are trying to compete with NVIDIA. I was just in Amazon's chips lab, AWS's chips lab last week, taking a look at some chips that they have coming out here. And I'm curious what you think would make some of the cloud players like an Amazon a formidable opponent to NVIDIA.
No, absolutely. I think we have to look at the cloud service providers as in some way competing with NVIDIA, but even more so being very strong customers for the company. Developing chips and developing cloud infrastructure are two different skill sets, right? So if I'm developing a custom chip in a cloud, only that cloud can use it. It's not going to scale, any chip that Amazon develops. It's not going to be used by Google. It's not going to be used by Microsoft. It's not going to be used by Oracle or Meta. So in some ways, it is serving a very specific need that, Amazon might have. Similarly, the chips that Google develops, the TPUs, they serve very specific needs. What NVIDIA has developed is a so-called, merchant, reconfigurable, programmable infrastructure that can be deployed across a very wide range of workloads, both for when these cloud companies are handling internal workloads, such as search, such as e-commerce, such as YouTube or, TikTok, like video recommender engines, or when it is serving a lot of enterprise customers through their public cloud. Which is why I mentioned that if you, take a step back and look at the broader accelerated computing market, I do think that 10 to 15% will be these custom chips, but they will have several different custom chips, across each of these specific cloud infrastructure. But because they don't quite have a way to go from one cloud to another cloud, their range of workloads, their applicability, their scale tends to be limited to just that cloud infrastructure.
Vivek Arya, who is the Bank of America Senior Semiconductor Analyst. Vivek, thank you so much for taking the time here today.
Thank you.
Thanks. Everyone, we've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. You're watching the Morning Brief brought to you by Invesco. Let's get to our vibe check on this Tuesday morning. It's looking good for Apple, the tech giant, closing in positive territory for the year yesterday. If you remember, the stock had previously been down as much as 14% this year at trough in 2024, but Apple's quarterly report in early May eased some concerns for investors about its growth trends and sales in China. Now, there you're taking a look at the year-to-date as of right now, and unfortunately, it looks like we've shifted back into, actually, that's a plus sign. My goodness, I had to squint to see it, but anyway, we are
just barely above that flat line.
Barely up 0.5%, yeah.
Right? Yeah, I mean, it's like not great for a company like Apple is that close to the flat line. You really want to be seeing bigger gains than that, right, Brad? But it is interesting to your broader point. When you look at the Apple stock compared to the Nasdaq's up almost 11% this year. As of the close, when Apple was in positive territory, it was up just 0.8%. Now, this is a upward trend for Apple, rising over 13% throughout the month of May, reversing a lot of the downside risk that we had seen impacting this name, putting it below its $3 trillion market cap. And to your point as well, Brad, the question about demand from China, really a sticking point for investors. And as we continue to get little pieces of data out of China, out of various manufacturers that show a little bit more of that demand, that's helping buoy this stock that really needs some help.
Yeah, the next big event that investors could potentially be looking at, WWDC, that's going to be incredibly important for really getting a sense of how this company is delivering even more in terms of its ecosystem for developers to iterate on top of. A lot of question mark around what generative AI could even look like within some of the consumer technology products here. Dan Halley has continued to do excellent reporting on that. And so we'll see exactly what the tenor, what the vibe of WWDC even. I'm getting super meta with it, not to confuse it with Meta Platforms, but ultimately here, that is going to be perhaps the next major event that we're seeing on this timeline for Apple shares over the course of 2024.
Yeah, hopefully we'll get something bigger than the new iPad announcement that we got at the last Apple event. We're looking for a little bit more newsiness, right? Looking for some newsiness. Well, we are going to work on finding Brad's iPad coming up. We also are going to have some breaking labor market data right here at the top of our 10 a.m. hour. We're going to break down what job openings are signaling about the economy. Plus, we've got ABB chairman and IBM board member, former CEO of Shell as well, Peter Voser. He's going to join me here in studio. And we're going to talk about EV infrastructure and the impact of AI on the move toward electrification. We're going to have all that and more on Catalyst. Keep it here. It's 10 a.m. here in New York City. I'm Madison Mills alongside Brad Smith. We're going to dive into the catalyst moving markets today.
That's right. Bad news is bad news for markets once again, as the hopes that weak data means more rate cuts are replaced by a fear of sharp economic downturn here. Stocks are mixed as the latest labor market data jolts crosses the wires right now. We got the latest for you on that in just a moment, though.
And Intel attempting to throw its hat in the ring in the AI chip wars. The semiconductor company announcing new artificial intelligence chips for data centers as it attempts to rival leaders like Nvidia and AMD, a little bit of a leader there. We're going to discuss the global winners and losers in the chip space moving forward.
And the meme stock superstar Keith Gill, also known as Roaring Kitty, is accused of market manipulation after a social media post from an account linked to him sparked a surge in the GameStop shares. E-Trade is considering kicking Gill off the platform. This is according to the Wall Street Journal. We'll dive into what this could mean for the stock and investors.
And we have breaking news coming up on our show here with labor market data. JOLTS job openings labor turnover survey coming out for April, coming in at 8.06 million versus the 8.35 million that was expected. So that is a miss. That is potentially going to be good news for the market. And taking a look at the overall survey, we're seeing several different factors coming in below estimates here. The April job opening rate coming in at 4.8% versus 5%. This is a percentage of the total employment plus openings that you're looking at there. Also, the pace of hiring, critical to watch, coming in just in line here at 3.6% versus 3.6% the prior month. A lot of guests telling us that the pace of hiring is very critical to watch. So interesting to see that coming just in line. We're seeing the stock market coming, kind of pairing some of its earlier losses, the S&P nearing that flat line. So this could be an indication that the JOLTS data coming in below estimates kind of across the board is looking good for markets. Also, quickly want to mention layoffs. We're seeing 1.5 million people fired or laid off in April. Previous year, it was 1.6 million. So seeing a little bit of a decline in the number of people laid off. But overall, that headline number coming in below estimates, Brad.
Yeah, I'm focusing in on some of the areas where we did see job openings change. The biggest decreases in healthcare and social assistance, down 204,000, and then in state and local government education as well by 59,000. However, you did see a little bit of a rise in private educational services. That was up by about 50,000, as you mentioned. That rate for job openings a little changed, 4.8%. The number of hires as well within this report, the rates there, little change. It held at 3.6%, and increased in durable goods manufacturing, and ultimately, you did see some decreases, though. That came in arts, education, and recreation. That was down 45,000, and federal government jobs down 8,000.
Yeah, it's interesting, Brad, because it really paints this picture of a potential Goldilocks scenario. But the big question for markets is whether or not we're going to see things tip into too much softness, right? So that's going to be my big question moving forward in our show today. Are we seeing too much softness that could be a catalyst for negative growth moving forward? Also interesting, quit rates coming in steady at 2.2%. We've seen it there for the last 4 months. The layoff rate still low at 1%. That layoff rate indicating to me that maybe we are in this kind of immaculate scenario where we're seeing just enough softness to keep the Fed happy, but not too much softness so that we're seeing an economic downturn. So definitely interesting to continue to follow here. Job openings, the first of several looks we're getting at the labor market this week. And the state of the jobs market, obviously a huge catalyst for the Fed. But some economists saying we need to see a bit more moderation in the labor market before the FOMC can begin to cut rates. So what does this data tell us about the path forward here? To discuss, we've got Veronica Clark, Citi economist. We also have Marianne Bartels, Sanctuary's chief investment strategist, with us. Veronica, I want to start with you. Just talk to me about these JOLTS numbers. Markets coming off their lows in response, but not seeing too much upside activity. In terms of the economic picture, how critical is this data in your overall thesis?
Yeah, I mean, I think this is a pretty important data set, but it's kind of painting a similar picture to what we've seen in the last few months, where we know that demand for labor is definitely coming down. You see that very obviously in the overall job openings number declining, but also in a very low hiring rate. That's a really important detail of this JOLTS data. We definitely see that hiring is pulling back. It's still a favorable sign that layoffs are still low, but that would really be the last step of a weakening labor market. And we definitely see signs that businesses are looking to cut labor costs by not hiring.
And Marianne, want to get your read in on this as well as what the Fed is going to be looking for in the economic data coming in the form of the employment situation later on this week, and then additionally a little bit more of a read on the labor situation and employment and labor market more broadly as we get even readings like this as far back looking as they may be for JOLTS. We get a little bit more active with the ADP and brought more in line with the jobs report later on this week too. What's the Fed going to be looking for?
So I think the Fed is looking at a broad set of economic data. Of course, they're looking at jobs. That's very critical. They're looking at inflation measures. Yesterday, we had the ISM manufacturing, and that dipped below 50, a little bit of softness. Prices came down, but the employment number in there actually was a little bit stronger. So now we get the JOLTS, and we're getting some softness. So you're seeing some mixed data. That's very normal. But I really think the Fed is still very focused on inflation. And I do think inflation can continue to come down. And we're still forecasting that the Fed should be able to cut rates by 25 basis points in September. And again, that's as long as the data is supportive. We do think that they'll cut rates. And we think that's supportive of the bond market and the equity market.
Well, I want to talk to you both actually about the big R elephant in the room of a potential recession. Veronica, starting with you. You know, it's so fascinating how quickly things change, right? Because just a couple of weeks ago, we had PMI breaking out. The economy was too hot. Now, all of a sudden, the economy potentially too cold. People freaking out about the Atlanta Fed's GDP numbers. Are you seeing any evidence in the data about a potential recession? And if so, what are you looking at?
Yeah, no, we absolutely do. That's actually still in our base case that we're going to see just further weakening in the labor market, further weakening in activity and spending. You've already seen signs that, in the first quarter of this year and in April, consumption is really starting to slow down. We had those revisions lower to consumption in Q1 last week. Residential investment, which was a really big support for Q1 GDP growth, that is now turning. You've seen housing, turning again, construction falling, home sales falling. And to us, it does look like, this is a weakening labor market on the brink of an even weaker labor market, even further, job loss that we're going to get in the coming months.
So a little bit of pessimism from you there, Veronica. But Marianne, I mean, we're still near all-time highs, right? We're coming off of them, but we're still in this bull market. So where are you on the kind of recession to no recession scale?
So I use anecdotal evidence. I'm not officially an economist. And I'm sure if you've been out at restaurants, they're completely packed, and not just on the weekends. I've been flying the past 2 months. Every flight I've been on has been completely packed. The consumer's still spending, however, selectively. And I think as long as the consumer is spending, I don't see a recession, considering the consumer such an important component of the economy. But when it comes to the stock market, it's earnings, earnings, earnings. Mm-hmm. And the seasonality of estimates normally start coming down. And what we're actually seeing is the opposite. Analysts are taking their numbers up. And with the strong earnings backdrop, we're still very bullish. We never said sell in May and go away. We actually said buy in May, but sell by Labor Day. Looking for that seasonality correction around September and October. But we're still pretty bullish. We're still looking for 5,600 to 5,800 on the S&P. So we think, there's clear sailing for the markets from here.
Yeah, it's really interesting, and it's a great point, Marianne. And Veronica, I'd love to get the economist perspective from you, because based on some FactSet data during the months of April and May, analysts actually did increase EPS estimates in aggregate for the second quarter. What does that tell you about the strength of the consumer right now?
Yeah, I'm not an equity strategist by any means. We listened to earnings calls, and it did seem like consumers had a bit of a pullback, even consumer equities, in the earnings that we've heard over the last couple weeks, and we definitely see that in the hard data. I mean, it's been 3 of the last 4 months where real goods spending has declined. Restaurant spending in real terms has declined for 4 of the last 5 months. So I do think we're seeing a pullback in this more discretionary type of expenditure. Delinquency rates on credit cards records that have well surpassed 2019 levels. It is favorable that unemployment is still low, but as people become more worried about employment prospects, and we see that in some survey data, we see that in the low quit rate in this JOLTS data. If spending pulls back even more, that does create an even bigger pullback for these consumer businesses.
Yeah, maybe that's telling us Dollar Tree will be the most important report of this week here. Veronica Clark and Marianne Bartels. Veronica is a Citi economist. Marianne Bartels, Sanctuary Chief Investment Strategist. Thank you both for taking the time here with us today.
Thanks.
Certainly. Well, Intel is the latest chip maker to announce new artificial intelligence chips for data centers. Intel is currently lagging behind the other big U.S. names in the space, Nvidia and AMD. And when you take a look at the global semiconductor industry picture, who is winning and who is losing this chip war? Big question, and our very own Akiko Fujita here with some answers and insight. Hey, Akiko.
Good morning to you, Brad. You talk about the AI picture here. Tough to argue with anybody being a big winner except Nvidia so far when you consider the sheer scale of what they've been able to accomplish. You talk about data center revenue alone, the category that's seen the biggest bump from the AI boom rose 427% from a year ago in its most recent quarter. But as you noted, we've seen those competitors making aggressive inroads at Computex over in Taiwan. You heard from AMD announcing their own next generation AI chips for laptops, the company vowing to announce a new AI chip every year. That came after Nvidia's Jensen Huang made the same vow the previous day. Moving forward, though, the stat points to the battle that is playing out globally. Private sector investment into the chip space is expected to top $2 trillion over the next 8 years. That's according to data from BCG and the Semiconductor Industry Association. You compare that to $720 billion in the last 10 years. So that's a big bump here. And the biggest investments have been coming through from 3 key regions. We're talking about the U.S., South Korea, and Taiwan. Much of those investments certainly have been accelerated as a result of the CHIPS Act in the U.S. As we've noted before, that has spurred a global race for subsidies, with Europe and other regions trying to match the funding that the U.S. is providing to establish a homegrown manufacturing hub and wrestle market share away from the global leader, which has been Taiwan. All of the players in this space are chasing a roughly $1 trillion opportunity. That is what the global semiconductor revenue is expected to top in the next decade, according to consulting firm International Business Strategies. But it's important to remember that this isn't all about AI. While that gets all of the attention, the foundational chips, those that are used in cars, smartphones, even military equipment, that still makes up a bulk of this market. So we're talking about legacy chips that are 28 nanometers or larger. And guys, when you think about that, the chip designers like Nvidia get all of the attention, but this is an industry that is still very much built on manufacturing. TSMC, the big name we talk about, we're talking about chip making or chip equipment makers like ASML. The list goes on. So a very diversified market, even though Nvidia, AMD, and Intel get all the attention.
Right, it's a really good point, Akiko, and I know that you've been following the space closely. Lots of different names that could potentially take up a little bit of that market share from the big dog in the room, Akiko. Thank you so much for joining us. Really appreciate it. Now, coming up here, Ford sales are out. We're going to dive into what they signal about the auto industry coming up after this break. Well, Ford is out with its May sales numbers that outpaced the industry, expanding by 11.2% on new vehicle offerings. Ford saw gains coming from its portfolio of hybrids, trucks, and EVs. Now, CEO Jim Farley stressing the importance of its variety of vehicle offerings. And in an interview with Yahoo Finance's executive editor, Brian Sozzi, here's what he had to say.
It's pretty clear to us what the next 5 to 10 years look like. You know, it's not going to be a future that's only EVs. It'll be a mixed powertrain of EREVs, PHEVs, hybrids, pure ICE, if you're towing something, and electrics. And electrics will be a big part of the industry, but not the only part of the industry. We're going to have a lot of software in our lives.
So for more on Ford's sales numbers, we're going to be joined by Yahoo Finance's Praz Subramanian. Praz, always great to speak with you. Talk to me about what's going on with Ford in terms of these sales numbers and the impact on the stock, because we are seeing it still moving to the downside, which could just be the overall market vibe today. But this is kind of a big beat when it comes to their sales rising for vehicles by over 11%, right?
Yeah, I don't think the stock price move today is connected to this sales number. I think the sales number is pretty surprising, pretty big month here. The sales booming, like you said, 11% in May, year over year, up 6% month over month. Ford also claiming it's gaining market share in the U.S. with these numbers. And what's happening here? It's, of course, those hybrid sales that Farley alluded to. Maverick hybrid up 111%. The F-150 hybrid, the all-new one, up 51%. Comes after Ford sort of leans in more on hybrids, pushes back a bit on those EVs. Those EV sales, by the way, are up big too, totaling around 9,000 EVs. Not much, but up 65% compared to a year ago. The problem is those EVs are losing money, but nonetheless, it is an overall big month for Ford.
All right, Praz, we're going to have to leave it there, but thank you so much for joining us. We got to get to some of our other trending tickers here. Shares of Flutter moving higher after Oppenheimer initiating coverage of the company with an outperform rating. The analyst saying that Flutter is outpacing competitors at merchandising, pricing, and innovating parlay products. Yahoo Finance senior reporter Alexandra Canal has more on this story. Now, Ali, this is one of the kind of online gambling services in the space. Talk to me about what exactly this news means for Flutter moving forward.
Yeah, Flutter is a parent company of FanDuel, and even anecdotally, this is one of the top platforms. If you are a sports bettor, if you are a gamer in any sense, and you want to go and place your bets, you're probably going to FanDuel as one of those options. Now, according to this Oppenheimer note, they say that Flutter provides players the most pre-built selections with seamless bet building experience. And we have seen a flutter, no pun intended, of positive sentiment across Wall Street in recent weeks when it comes to this company. Jefferies reiterated their buy rating last week. JPM reiterated its overweight rating. We also saw a price target raise and buy from Deutsche Bank. And at the end of May, we did see Flutter complete its move, a primary listing of shares from London to New York. They also recently moved their operational headquarters to New York, switched up the CFO as a result of that. CEO Peter Jackson said that both the primary listing move as well as that HQ move represented basically the confidence that they have in the U.S. betting industry. It continues to be one of the most profitable areas for the company, especially as we've seen a surge of legalized sports betting in more than 20 states. Now, I will say that there's still some potential risks here moving forward. I mean, Illinois Senate, they passed a bill which will raise taxes on sports betting operators. And it's interesting to compare the tax rates to some of those other states because New York has a 51% flat rate for those operators. PA has a 36% rate. But in Illinois, they're proposing a rate that would depend on the revenues that you generate. So the more money that you make, the more you'd have to pay. So that's a potential risk moving forward for not just Flutter, but really all of these companies.
Right, the tax implications are huge for a lot of these online betting companies. And I know you follow all of those differences closely for us, Ali. So thanks so much for joining us. We really appreciate it. Now moving on to GameStop, of course, E-Trade considering removing meme stock leader Keith Gill from their platform after growing concern about potential stock manipulation around the recent GameStop purchases. That is according to reporting from the Wall Street Journal. For more on this story, we're going to bring in the reporter who broke it. We have Anna Maria Andriotis. Anna Maria, thank you so much for being here with us. I mean, start with just what happened here, right? Talk to me about what trading behavior your sources within Morgan Stanley noticed that indicated to them that this could be a sign of potential behavior that would be worth banning someone over.
Great to be speaking with you. So the concerns began about 3 weeks ago. This was following the X post on May 12th from the account that's associated with Keith Gill, where it showed him leaning in, sitting on a chair, leaning in. And the following day, people working at Morgan Stanley looked into his E-Trade account and saw that he had made a large purchase of GameStop options before that tweet had gone out. So what followed were conversations that have been ongoing around. What followed were conversations that were ongoing around. Well, is what's playing out here okay? Yeah. Specifically, is what's playing out that like he bought these options, and then this tweet went out, and what kind of impact that had on the stock? Is this manipulation or not? And should we be hosting him on the platform? What happens if we remove him from the platform? And so around that, there's basically been several layers of questions here and concerns.
Yeah, I recognize that from your reporting here, and I know that obviously you cover Morgan Stanley, so you have a lot of sources within the firm that you were able to speak with as part of your reporting and ability to break this news. Talk to me about what your sources within the firm, though, are saying, who might be flagging that this could be a bad move when it comes to E-Trade in terms of the impact it could have on other customers. What are they saying to you?
Well, that's part of the discussion internally, which is what happens if we do remove him from the E-Trade platform? What happens if he goes public? Might we risk a bunch of his followers who have E-Trade accounts ditching E-Trade? So there's several layers to this, right? There's concerns around is what he's doing manipulation, which started a few weeks ago, those concerns following the May 12th tweet. In addition, there's what are the implications for E-Trade customers, for E-Trade with regards to the customers that it might lose, given the large followers, a large number of followers that he has. So this isn't an easy calculation that's playing out internally, and it does touch on some gray areas, and it's an area, kind of a gray area, that regulators themselves are looking at.
Right, we know that the SEC is looking at this behavior as well. I'm just curious, in terms of your history covering Morgan Stanley, how abnormal would it be for them to shutter an account like this one?
So Morgan Stanley, like all brokerages, when we talk about the E-Trade portion of it, like all brokerages, has the right to shut down accounts for a variety of reasons, and that's stated in their policies in a pretty clear way. In addition, what I learned as I was learning about all of these developments is that it's pretty normal for them to review accounts on a somewhat routine basis, especially if they have some questions around what's going on. And that's part of what played into E-Trade employees looking into Keith Gill's account after May 12th, May 13th, to see, well, there was this sudden surge in demand for GameStop stock. What happened here? So brokerages in general have a pretty wide-ranging latitude in terms of what they can do with regards to keep or not keep clients' accounts.
Really interesting stuff, Anna Maria, and congratulations on the scoop. Really important news, of course, this week as the stock continues to be on the move consistently. Thank you so much for joining us.
Thanks
that was
for your
Anna
time.
Maria Andriota. She's Wall Street Journal's reporter joining us on the news about Roaring Kitty. Now, coming up, Paramount's merger saga continuing. We're going to break down how we got here and what is to come after the break.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Well, a big day here for Paramount after news of their potential merger seemingly coming to an end after they reportedly reached a deal. But what does this mean for investors moving forward? We have Robert Fishman, MoffettNathanson Senior Research Analyst, joining us. I'm also joined by Yahoo Finance's Alexandra Canal for this interview. Robert, thank you so much for being here. I mean, there's no shortage of news from Paramount this morning, right? We're hearing news about job cuts, streaming opportunities, also this potential merger. What sticks out to you as the most important piece for investors to be watching?
Well, I guess the obvious answer is, what does Sherry decide about the future of the company, given the proposed new updated terms that are on the table with Skydance's bid?
So then, Robert, you know, what we heard this morning from the shareholder meeting, Maddie was just mentioning it, we have $500 million in cost savings, a potential streaming joint venture down the line. Do any of those initiatives excite you, or is it all a moot point, depending on what happens with this deal?
Yeah, I mean, I'd say it's a very confusing time and an awkward time probably to be having this annual meeting today, given the uncertainty about the future of the company and how real this plan is and whether we'll actually see it, I think, to your point, because we don't know how long this is actually gonna take place and what the real future of the company is gonna be if Sherry ends up deciding to go forward with the Skydance deal as early as the next couple of days. So it's unclear as far as where this plan is actually going to be implemented and how much this future plan might be different as part of new leadership.
And there's a town hall with employees that's set for tomorrow. Do you expect a lot of the same in terms of what the plan is and the strategy go forward move that we heard from management today on the earnings call, on the annual shareholder meeting to take place at that town hall tomorrow?
Yeah, I mean, again, by tomorrow, for all that we know, it's possible that there's a deal in place already. So it should be known within the next few days, I think, is what the reporting suggests, whether Sherry wants to go forward or not. But this alternative scenario with the office of the CEO and the updated plan that was laid out today would probably be the marching orders if Sherry decides not to go forward with Skydance for whatever reason.
If they do go forward, though, how likely is it that some of the plan laid out today would still be in place moving forward, or should investors anticipate that what they talked about today would sort of be off the table and we'd get a completely new round of insights for the company moving forward if that goes through?
I mean, I'm sure some of it would be at least considered as far as the new plan for the company, because clearly the company needs to be focused on additional cost cutting given the pressures of the revenue and cord cutting, and even more so advertising recently, as secular challenges for the entire TV ecosystem continue to emerge and get worse so over the coming months and quarters. So given the shift in landscape, of course, the company needs to be focused on cutting additional costs out of that system so that it can help offset the revenue pressures. But the real question here is the future of streaming and what they decide to do with Paramount Plus. And if they want to go forward with some sort of new JV type of partnership with Paramount Plus, or look to keep Paramount Plus going and I guess try to license content in a different way than what they've been doing previously.
And Robert, let's talk about that sweetened Skydance deal. Based on the latest reporting, $8 billion in total equity. We have a $15 premium for those non-voting shareholders, a cash injection of $1.5 billion, $2 billion for Shari for her share of National Amusements. Do you view this as more attractive to those non-voting shareholders, especially because that was really the crux of the issue leading up to this week?
Well, I guess the question would be more attractive relative to what? And so relative to the prior reporting of the initial deal, I think the answer is clearly yes. Relative to other proposed deals out there, that's, I guess, a little bit less clear. But I think it does seem to be the case that this is the deal on the table right now. And again, if the reporting is correct, the special committee has essentially already approved it. And now it's up to Shari whether she wants to move forward or not.
I know you don't have a crystal ball. I know we don't know ultimately what's going to happen. But if this deal does not go forward, one, would you be surprised? And two, does that mean we shouldn't expect any type of deal to happen this year and that Paramount's just going to sit back and try to correct their problems internally?
Well, I think what you heard today is essentially the plan as if there is no deal going forward. And again, there's really only one person that can decide that as far as the crystal ball goes. So ultimately, this is Shari's choice, and Shari gets to decide, given her voting control of the company and the future of the company and which direction she wants to go. But as far as what the plan looks like without it, I think that's what the initial vision that was laid out today. And then we're going to be getting more details in the coming months if there is no deal.
But Robert, to Ali's question, what percentage would you put on the likelihood of a deal going forward here?
The percentage question. So I would say, right now it does seem more likely than not that the Skydance deal would go forward. Again, that's all based on the public reporting. And seemingly what Shari wants to do as far as the taking the future of the company and putting it in someone else's hands that will not completely break up the company. I think that they're probably going to be open to asset sales and explore different possibilities here. But I do think, at least, again, based on what has been publicly reported, that Shari is aligned with the Ellison vision and Skydance vision in terms of what they want to do with the company.
All right, Robert, appreciate you playing ball with my percentage question there. Thank you so much for joining us. Robert Fishman, he is with MoffettNathanson. He's their senior research analyst. And of course, our very own Yahoo Finance's Alexandra Canal as well. Well, we are taking a pulse on the future of electrification and automation. I'm going to be sitting down with Peter Voser. He is ABB's chairman. That is coming up right after the break, so stick with us for more. Microsoft announcing job cuts this week. The tech giant not the only one. Google also reportedly cutting back on staff. Over 1,000 people are expected to be impacted. So why are these tech giants allegedly laying off workers despite strong balance sheets? To break this down for us, we've got Yahoo Finance's very own Dan Howley here with us. Dan, what's going on with the layoff news?
Yeah, Maddie, some of the layoffs from Microsoft have to do with its kind of mixed reality unit. That really suffered heavy losses previously, and now they seem to be kind of continuing to move folks out of that. They're still continuing to offer their HoloLens 2. That's their mixed reality headset. They have that contract with the government, so they're continuing to offer that. But some of these layoffs have to do with the cloud unit, whether that's with sales. They say it's, according to these reports, about strategic alignment, and ditto that for Google, which is also seeing layoffs in that unit, basically saying this is all about strategic alignment. Now, they are continuing to pump, both companies continuing to pump billions of dollars into their cloud services as they build out their generative AI offerings and their ability to host generative AI capabilities. So it's not as though they're pulling back on spending in those places, the cloud unit. It's just that they seem to be wanting to move money around to different opportunities. And so that looks to be where they're at this point. Both companies, as well as obviously Meta and Amazon, had huge layoffs in prior years as a result of overhiring from the pandemic. It doesn't sound like this is something along those lines where they had simply too many employees and now they have to shed them because they didn't, predict what would happen after the pandemic very well. This seems to be more of a just generalized issue where they're trying to kind of move bodies around and move money around to fill in gaps elsewhere.
All right, Dan, we're going to have to leave it there, but appreciate you joining us, as always, on All Things Tech. Thank you so much. Now, manufacturing data out this week showed weakness in the month of May. This is the second straight month of slowing manufacturing growth. To break down what a CEO and executive in the space is seeing in the automation and electrification manufacturing space, we've got Peter Voser. He is ABB's current chairman, and he is the former Shell CEO, joining us here in studio. Peter, thank you so much for being here. We really appreciate it.
Thanks for having me.
So I want to start on this data that we're seeing about some potential softness in the manufacturing space. To what extent are you seeing that in your role at ABB? What is that looking like?
Actually, for ABB, which is concentrating on electrification and automation, we haven't seen that slowdown. We have actually seen a pick up in the short cycle orders, which normally is a good sign that the economy is actually doing much better than anticipated, because that has been coming down for a few quarters. So far, I think we are still in the camp of it's better than expected, but the second half will have some uncertainty.
That's interesting, given that the data has sort of looked worse in terms of that in the first half. So we'll have to see in the second half. But I want to get to what you're seeing in the EV space while we have you. I know the majority of your revenue comes from building new energy systems. And you've said that the whole electrification network when it comes to EVs really needs to be up to speed. Where do you anticipate that up to speedness coming from? Do you anticipate the private sector coming in on infrastructure? Do you think it'll be company driven at the public sector?
I think it has to be predominantly private, and it has to start with the utilities actually providing us with the electricity, i.e. that means the networks needs to be further developed, the infrastructure, and some of the acts there in the US do help if I stay with the US, but then also on the charging infrastructure, in my opinion, that has to be a privately led kind of drive. We are a global leader on the charger itself, but we are not building the infrastructure for that. But this needs obviously more private money. It needs more investments because I think the electric vehicle side, the demand is there. We see a little bit of a slowdown at the moment because subsidies are going out of the market. But I think the long-term change into the new energy system, which is electrification, is going to happen. Therefore, we need urgently infrastructure investments, and that should come from utilities and other new players going into that area.
Well, when you hear about a Mercedes, a Stellantis pulling back on EV battery factories because of poor demand, what read-through does that have to your business?
Obviously, that could mean less charging for us. But given that we have a backlog, I wouldn't see this as actually impacting us a lot, because I think the infrastructure normally should be ahead of the usage of the technology, so the cars itself. Now, over the last few years, this has been the other way around.
Right.
You saw a lot of EV cars coming in, and then the Electrify Americas came in Europe. It's the Ionity. It's really the governments and the private sector now building the infrastructure. And I think, therefore, this will happen. I think we are selling a lot of chargers at this stage in the industry, but there has been a slowdown, there is no doubt about that. But the long-term perspectives are exactly the same, in my opinion, very positive.
I want to talk to you about China. We've seen executives like Elon Musk going to China, now saying that he favors no tariffs on Chinese EVs. Regarding the kind of tariff tit for tat that we might see bubbling up and kind of the tension worsening over that between the US and China, what impact does that have for you, and where would you say you lie on the tariffs conversation?
I think there are two answers to this one. One is in China. Now, I have to tell you that ABB never had global supply chains. So we sell in a country what we produce in a country. That's the same in the United States or in NAFTA. But in China, it's around 85%. In Europe, it's around 95%. We produce and sell there. Therefore, the tariffs for us are a little bit less relevant.
Sure.
Now, coming to the US, we had this situation also between 2016 and 20, for example, where tariffs on steels actually were going up. And as long as we can demonstrate that the steel cannot be produced, for example, in the United States, we normally got a favorable response out of Washington that these tariffs were not hiked that much, because at the end it would be the consumer in the US paying it. So I think let's see how this will develop. But tariffs on the imports of other countries for products you cannot produce in the country, I think there we need to find a different solution than just actually putting tariffs up, because at the end it will be the US consumer paying the bill for that.
As an executive that works really globally, though, I am curious what it's like for you to kind of walk the tightrope between the US and China. How do you navigate those conversations when we do have this tense backdrop?
Yeah, I think as a company, you have the obligation to look at these risks. And therefore, we have a plan A, B, and C in China. Should anything happen in Taiwan, should anything happen more on the tech war, we do use different technologies in China for our local business. So we are not using, let's say, Western technology. So you have to adapt your system in order to actually be able to produce still and sell. We look at this from a macro perspective and then bring it down to micro, where we then really manage the countries. And yes, it's a concern on the one side, but on the other side, we are paid to also deal with obstacles in the road, and that's what we are doing in terms of planning, risk management, etc.
I love that take. It's hard, but that's what we're paid for, right?
Yes.
I want to get your take on one last thing here. You're on the board at IBM, a company that's really successfully navigated the transition to the AI boom, creating a fund for AI startups, for example. What was it like in the room in terms of meeting with the board? What single decision were you a part of that kind of laid the path for that AI transition and adoption at IBM to go so well?
I'm not the official spokesperson, but I give you an answer. I think over the last few years, under the management and the leadership of Arvind, obviously IBM was positioned in a very different way, starting with the major acquisition of Red Hat, which was a cornerstone in the strategy which we are using, the spin-off also of Kyndryl. And with that, actually, in the discussions in the board focused on new technologies. And AI dominated the last few months. I think in 2-3 years' time, you will see that quantum will dominate the boardroom as well. And I think IBM is a B2B business. It's not a B2C business. And therefore, I think the tremendous opportunity which lies in the industries by using AI, I think IBM is well positioned to actually go in and get their fair market share of this one. And I think that's not yet reflected in all the write-ups I see on IBM, because the B2B business comes after the B2C business.
You're already having discussions about quantum?
Of course we have, because that's a long-term strategic emphasis of IBM, and I think it's one we all look forward to.
All right, Peter. Well, we're going to have you joining us to discuss the future of quantum after this AI boom starts to wrap up. Thank you for joining us. Thank you for coming in studio. We really appreciate it.
Thanks for having me.
That was Peter Voser. He is ABB's chairman and the former CEO of Shell as well. You're going to have all of your markets action ahead, so stay tuned right here for more. You're watching Catalysts. update on job openings could be a sign that the labor market's starting to have a little bit of weakness here. The data following a reading on activity in the manufacturing sector that did come in solidly weaker than expected. Now, some economists scaling back expectations for economic growth this year. For more on this, we have our very own Josh Schaefer. And Josh, I know you cover this from the perspective of markets in particular, but also you look at every single note that comes in so critically. I'm just curious what change you're seeing in terms of the reading and the tenor about the economy, of course, but also markets.
Yeah, so when we started the year, we wrote a story back in, I think, February of how the economists kept chasing the market higher.
Yeah.
They were chasing the economy higher. The economy kept outperforming, and so everyone was boosting their GDP targets for the year. And that seems to have slowed a little bit, really, in the last month. And that's largely because of data that we've seen. I mean, if you remember the Q1 GDP print that we had, now at 1.3%, there was expectations for that to be over 3%, right? So that was sort of the start. And then from there, everything has come in just a little bit softer, right? You look at retail sales for last month coming in flat. Economists expected that to be a little bit better. This manufacturing data, a lot of people thought we were going to start to see a pickup in PMIs. So what you're looking at here is the Atlanta Fed's GDP Now tool. This takes in data points as we go throughout the quarter to sort of extrapolate what GDP will be. That's now down below 2% for the second quarter. Just a month ago, it was up over 4%.
Yeah.
So just seeing that line sort of tracking down is essentially what we're talking about here. And Maddie, I think the important thing to highlight, though, is we're talking about the economy maybe not outperforming.
Mm-hmm.
That doesn't mean that people necessarily think it's going to underperform here.
Yeah.
There are not a lot of people bringing back their recession calls yet.
Right.
We are not at that level. You look at the job openings number today, a little over 8 million job openings. Yes, it's the lowest level in 3 years, but you still look at the ratio of that to unemployment, and you're really sitting at kind of pre-pandemic levels, and you have a quits rate that's not moving lower, right? You're at 2.2% for 4 straight months. So the labor market still seems to be on relatively solid footing, which is why I think people still feel overall okay about the economy, but not great.
Right, they may feel meh, as you
Right.
said earlier, but that doesn't necessarily mean we're heading towards a recession, which is a good reminder for me because I keep asking guests, well, now are you starting to worry about the softness? You know, the GDP Now figures tipping a little bit, and to your point, maybe this is just what a soft landing looks like.
Yeah.
Maybe this is exactly what we've been wanting, what the Fed has been wanting for so long.
And when you sort of spin that forward and think about it from a market's perspective, right? So like, if we were to have the economy continue at this pace, it sort of fits with a lot of strategists' base case right now, which would be for the S&P 500 to finish at maybe 5,500 or 5,600.
Yep.
If we were to have seen GDP keep outpacing and people feeling a lot more bullish on the economy, that's when people say maybe 5,800, 6,000.
Right.
Because you're starting to really outpace, and that's just not quite where we're at, which is why I think it's been interesting to sort of watch this shift of, okay, maybe at some point the consumer is going to slow down a little bit.
Yeah.
And things are not going to keep fully outperforming. Maybe we're not entering some type of new productivity regime, yada, yada, yada.
Yeah.
But
AI.
it's only been a month of data.
Right.
So I'm sure we'll change the narrative next month.
And of course, we've got earnings season coming up constantly, so we'll be able to monitor the consumer then as well. Josh, thank you as always. Really appreciate it. Coming up, wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, job openings falling in April to their lowest level since February of 2021. We'll tell you what it means for the labor market at large. And housing hurdles. New Redfin data reveals Gen Zers' top voting issue has to do with affording the keys to their own kingdom. We'll dig into the data. Plus, how to make a foolproof emergency fund. We ask an expert for the tips and tricks to better saving habits. All that and much more on today's show. But first, we got a fresh read on the labor market this morning. April job openings falling to their lowest level since February 2021. Meanwhile, the number of hires didn't change much. This is all a sign that in some sectors, employers are still onboarding new workers, but the number of jobs available in aggregate are continuing a downward trend. So what does this mean for everyday workers? Here with more, we've got Mark Hamrick, who's the Bankrate Senior Economic Analyst. Mark, great to have you here. Just want to get your read through on what we saw come through in JOLTS this morning.
Good morning, Brad. Great to be with you. I think this is pretty consistent with what we expect in the context of a job market and a broader economy that are normalizing after the disruption, the volatility, the distortions associated with the pandemic. And so you referenced there the number of job openings is the lowest since early February or early 2021. Well, what was going on then? It was the rush to reopen the economy in the months before that. And so we had job openings topping 12 million, which, it was mind-blowing then. It's still mind-blowing now. But the number of job openings is still above pre-pandemic levels, which is healthy, I think. And we'll see just how this normalization or perhaps slowing process works its way through the system as we get into the second half of the year.
Mark, and you laid it out well. I mean, this week we've got a ton of data that's coming forward on the employment situation front in totality. Of course, JOLTS just being today, ADP private payrolls tomorrow, and then it all leads up to Friday's big jobs report as well. For the trend that we're seeing really emerging here, what is the Fed going to be looking forward to really shift the tenor of their conversation towards a cut?
Well, I don't think they're going to shift the tenor of their conversation. The conversation remains the same, attentive to their dual mandate, with the major focus being inflation, with prices too high and inflation above where they want it to be. And of course, if we were to see a significant weakening in the job market, which we have not seen, with the unemployment rate below 4% for more than 2 years, then let's think about that dual mandate, stable prices, maximum employment. Then they start to be a little more concerned about the maximum employment piece of that. But for now, the focus is almost exclusively on the stable prices piece. And, we have to get through, I would say, several months of data for officials to be attaining greater confidence that inflation is coming down closer to their 2% target.
Certainly. And all of these things in mind, how important is the wage data that we're going to get over the course of this week to that inflationary calculus that the Fed is running?
Well, of course, as you were beginning to ask that question, I was going to say what's incredibly important to the workers and even the employers who have to consider whether to provide those pay raises. But let's sort of hearken back to the fact that, first of all, wage gains have been moderating, as with the strength of the job market overall. And the Fed does not believe that wage gains have been a primary cause of the inflation that we have seen. I want to say we all know, but I'm not sure everybody believes it, that the source of inflation has principally been the supply chain disruptions. And then, of course, adding literally insult and injury to the whole situation was Russia's invasion of Ukraine, thinking about how that disrupted prices in a globally connected economy. But ultimately, these things are all normalizing, I think. What, of course, is still the real problem at hand is that prices remain elevated. And so even though we talk perhaps until the would-be cows come home about the level of inflation coming down, people are agitated and financially pressured by the reality that prices are still high, and the Fed really can't do too much about the latter.
It's interesting, Mark. Higher for longer rates is what we've continued to hear and have to really wrap our minds around. How much longer are we talking with that in mind? I mean, we've heard some economists change their projections for this year from what we were talking about coming into the start of the year. It sounded like 5 or 6 rate cuts down to 1 or 2, maybe even none.
Yeah, obviously, I think I'd be foolish to try to get over my skis on making a prediction about what inflation's going to look like 4, 5, 6 months from now. But, I do think the consensus is probably about as close as you can get to right now, where, maybe you get something on the order of 1 or 2 rate cuts by the end of the year, but we have a long way to go before we get there. But I think higher for longer has more relevant meaning to perhaps our viewers and essentially all the stakeholders in the economy. And I'm going to focus primarily on consumers for this, and who are ultimately borrowers and savers as well. And that is that higher for longer can also mean that we'll not get back to the extremely low levels of interest rates that we saw not only immediately after the global financial crisis, but during the worst economic parts of the pandemic. And Chairman Powell has said that that's his expectation as well. And so what does that mean? Just as much as those times were, in a sense, historically distorted, perhaps normalization means that we have higher rates than what we had seen during those crises and really for the balance of the 2010s. And so that means that, perhaps we shouldn't expect mortgage rates at 3% and just barely above. We shouldn't expect borrowing rates to be as low as they were more broadly, but also we may see better yields on savings than what we saw during those low interest rate years, when essentially the unintended consequences of that low interest rate policy was that savers were the unintended casualties of that.
Mark, always great perspective and insight. Mark Hamrick, Bankrate's senior economic analyst. Great to see you, Mark.
Thank you, Brad. Great to be with you.
Thanks. Well, stocks in the red this morning as investors weigh signs that the surprising resilience in the U.S. economy might be starting to show cracks. Both the S&P 500 and the Nasdaq Composite trying to shake off some jitters here, but feeling the pressure on disappointing manufacturing data. So how should you play into the market right now? Here to weigh in, we've got Jessica Inskip, Director of Education and Product over at Options Play, and our very own Jared Blickery over there at the Wi-Fi Interactive. Take it away.
Yes, thank you, Brad, and thank you, Jessica, for appearing here today. We're going to talk about the SPY, and if you follow me on Twitter, that's my handle, @SPYJared. But here we are. These are record highs right here. We are off just a little bit. This was just a tiny, tiny little correction. What's your view on the market right now? And just tell me how you would play this in options.
Yeah, absolutely. And from a technical view, this is an engulfing pattern that gives us a bearish flag.
Right here.
Exactly. And so this gap right here is means of support. So from a technical view, I would want to understand my sentiment. Do I expect volatility and uncertainty to increase? Am I going to be bullish perhaps to that top where we were? And how would I position an option strategy utilizing that? So yes.
Here it comes, here it comes.
Here it comes. Yes, so that option strategy here, if this is my means of support where this gap is, I want a gap up. But this is my stopping point. Options can be directional, but we're in the middle here. So we can either A, position a trade here that's going to benefit as long as the security doesn't move and doesn't go as high here. That'd be a cash secured put.
Okay.
Or, excuse me, a short call. I do a credit call spread there. Or I can do a cash secured put here on the upside, or a call that's a little more speculative, but it'd only be to this spot, which puts probabilities less in our favor.
So you could bet that the market goes nowhere or just a little bit upwards. It's like a slightly bullish bias to it.
Exactly. And since we're in that blackout period with the Fed, there's uncertainty. Uncertainty and volatility go hand in hand.
Yes.
I would stay on the side of selling, which has higher probabilities of success because we're just selling the volatility. Once that collapse and uncertainty is removed, then you have higher probabilities of success. And just like if you delete.
So if you're selling options, though, that could mean a lot of risk. It depends on how you play it, though.
Correct.
So how do you interpret what we're looking at here?
Yeah, absolutely. I love this chart that you put together. So
I stole it.
That's fine. On the selling side, though, this is high volatility. So we have high volatility. If we have a naked put, this obligates you to buy the underlying security, but this means as long as the stock or indices remains above the current price, you're going to make out okay. It's not largely directional. It's neutral with a slight directional bias. But a short call spread, you're mitigating your risk. So if I were to sell a call at those all-time highs, I would cap my risk because I'm obligated to sell the security, I need to create a buy at a further out of the money. And that's how you create the spread. And that's the way that I would position that in this current environment, is selling a credit call spread right at those all-time highs.
All right.
Like we showed on S&P 500.
Great. And I want to move on to Apple. This is a different stock, a different look here. I'm going to show a 2-year chart so I can show just the trading range. This goes back about a year, and you can see we're at the upper end of this trading range right now. Which of these strategies are you thinking about to I guess, fulfill your view here on Apple?
Yeah, and I really think they're related because Apple is a huge component of the S&P 500. And in order to overcome when we're range bound or looking at these all-time highs, we need a catalyst. We have WWDC coming in.
That could be a big one.
Very, very soon. It could, but that's expectations. There's uncertainty, which means...
So maybe sell the news, or you're just talking about volatility?
Volatility, exactly. So in this case, there are two options. Selling the credit call spread would be a similar scenario. However, I do expect a catalyst. We've expected AI. I would accept stock ownership in something like Apple. Therefore, cash secured put.
All right, so let's go back to our 4 square here. Where does the cash secured put fall in this square?
Yeah, so this would be the naked short put. It's naked, meaning you just have a less of a requirement, maybe 25% of the exercisable value rather than 100%. That's the variation.
All right, so here is our options chart, and this is what you're considering doing, selling the June 21 $190 put for $2.50. Just kind of outline the risk and reward here.
Absolutely, beautiful. So right here, this is 190. This is where at the stock I need it to remain in order to be profitable. But because I'm selling this out to June 21st, I'm collecting $2.50. That represents this area here. So I've reduced my break even to 187.50. So I have this cushion. If Apple were to move adversely, the news weren't taken very well, I would be obligated to buy the security at 190, but it's offset by that premium of 187.50. If it continues to decline, I still have full stock ownership.
Which was kind of the goal in the first place,
maybe. Exactly.
Such optionality here. Jessica Inskip, always great to have you here. Back to you, Brad.
All right, thanks so much to both of you. Jessica Inskip, Options Play Director of Education and Product, and our very own Jared Blickery. Thanks so much. Well, with Roaring Kitty back in the news after provoking yet another GameStop rally, a question many beginner wealth builders have is, should you trust financial advice from Reddit and social media? For some tips and warnings, we're joined by Yahoo Finance contributor Ross Mack. Hey, Ross, good to see you.
Brad, how's it going, buddy?
Going well, going well. All right, so what do the good people need to know if they're tapping into FinTok or Reddit or any forum where people are sharing some of what their portfolio may look like?
Yeah, well, one, I'm always going to be in the camp of actually arguing that the benefits can outweigh the negatives, right? At the end of the day, we're talking about people coming together. We're democratizing the access to information, right? We're talking about maybe sharing, secrets and skill sets that otherwise we probably would not have heard of. And that can stem from health and recipes, parenting advice, and obviously money management and investing, right? I'm kind of part of that community, but there always is, you got to always err on the side of caution, right? And I think when it comes to the negatives, you have to understand that unfortunately, some people romanticize the idea of trying to attain something that they probably never are going to get, right? And as a result, some people can fall victim to either scams and bad players. I think if we look back historically, especially with this Roaring Kitty, that being the GameStop, a lot of people actually fell victim, right? You look at that and couple that with the Doge coins of the world or certain NFTs. What happened is people on these Reddit and, social media communities, they're now kind of having this herd mentality where it's like, hey guys, YOLO, HODL, everybody's going to have diamond hands, right? I remember when GameStop was so big, everybody was saying GameStop is going to get to $1,000. So now you have people thinking that they're going to become millionaires and instead end up losing their life savings and thousands of dollars. And so in the event you are part of the community and saying, okay, I heard of this on social media, I now want to take the advice. I think first things first, you have to ask yourself, is this person qualified that is giving me this, this advice, right? Is he or she qualified? And then next, you have to do your own due diligence, right? I can't stress that enough, right? Everyone do your due diligence because you have to ask yourself, is this company, how do they make money, right? What's the competitive advantage, right? What's the use case, especially we start talking about, crypto, et cetera. And then you just gotta ask yourself, am I gonna be using money or investing money that my life's not gonna, crash and burn in the event I lose it, right? You don't want to be risking money because every investment is a form of a risk. So you don't truly want to be risking money on a investment that has a lot of uncertainty that, you can't afford to lose.
Certainly, and we're taking a look at some of these safety tips as well here. I mean, it sounds really compelling sometimes when you hear stories of multiple traders hopping in, and there is a whole momentum trade as well that a lot of people perhaps get wind of, and they say, all right, I don't want to miss out on the momentum, but of course, you don't want to chase the trade, as Steve Sosnick from Interactive Brokers was telling us yesterday.
Yeah, I mean, I think there's a great saying is that the moment you hear about it, unfortunately, it's too late, right? And so in these momentum trades where, to your point, once it get publicized on social media, chances are there are some wolves in sheep's clothing that are actually, they're bad players, right? There are people that, are using, bots that are making you think that this is advertisement when in fact they're trying to now drive the price up and make you want to buy it. And now guess what? You're getting out. Same thing when we talked about sports gambling, right? At the end of the day, when you see someone wager $20 and made $200,000, guess what? That is advertising to hope that you yourself go do the exact same thing. And so when you hear about, certain cryptos or certain, YOLO various stocks, guess what? Unfortunately, you're being advertised to, and they're hoping that you yourself go buy it so that they can get out and exit at a higher price.
Yahoo Finance contributor Ross Mack. Ross, thanks so much for keeping tabs on all things Reddit and even more with the momentum trades out there. Appreciate it.
Absolutely. Thanks for having me.
Thanks. Coming up, everyone, housing hurdles. Affording that mansion with a moat isn't easy these days. With rising home costs and elevated mortgage rates, we're going to dig into the data preventing you from buying after the break. We got a lot of housing data in the last couple of weeks, and it really tells an overall story about the state of the housing market. Here to break it all down for us, we've got our very own Danny Romero. Hey, Danny.
Brad, the housing market is just unaffordable right now, and mortgage rates are largely to blame here. The 30-year fixed mortgage rate stayed above 7% since mid-April. And another concern with the housing picture is inventory. People aren't listing their homes. Sales of existing homes in April fell nearly 2% on a monthly basis, according to the National Association of Realtors. The price tag on a home hasn't come down either. The median sales price on a previously owned home was about $408,000, up 5.7% from the last year and a record high for the month of April. However, there's some improvement in May. There were 35% more homes for sale compared to the same time last year. Data from Realtor.com shows that's an improvement, but still below pre-pandemic levels. Now, if we shift over to the new home market, new home sales dropped 7.7% in April on a yearly basis, government data showed. Remember, builders have been building out smaller homes and giving incentives to buyers, especially with these higher mortgage rates. Brad?
And Danny, what can we expect to see next in the housing market? What is perhaps the next major movement?
There could be some changes coming to the housing market. Goldman Sachs economists revised their forecasts lower for home price appreciation growth. Now they're expecting prices to rise 3.9% this year, and that's down from the 5.5% appreciation expected back in February. So the slowdown in price appreciation could be a good sign, but the firm doesn't see conditions improving much for buyers, given the fact the strong demand and the healthy labor market. Brad?
All right, Danny, thanks so much. Keeping tabs on all things domiciles, homes, cribs, whatever you want to call it. Sticking with housing, it's not an easy market for potential home buyers who are facing elevated prices and mortgage rates and low, albeit recovering, inventory levels. And now a new Redfin survey reveals a whopping 91% of adult Gen Zers say housing affordability is their top voting issue ahead of the 2024 election. Here with more is Daryl Fairweather, who is the Redfin chief economist. Daryl, great to see you, and thanks so much for hopping on to discuss this data with us. I mean, just walk us through the findings here, because I think that's really what's striking about the number of people that are using this as a top voting issue.
Yes, and Gen Z thought of housing as being the most important compared to other generations. It tends to go down with age. The younger people care the most about housing. Baby boomers who are already homeowners already have fixed mortgage rates. A lot of them don't really see housing as their top issue. They care more about other things.
Sure. Yeah, and so with all of this in mind, where are we seeing moderation in the housing market? Danny was just laying out some of the latest data that's come through via the couple weeks of economic data. But I mean, even this morning, it seems like we're getting more fresh readings just about affordability.
When it comes to buying a home, it is, for the most part, less affordable now than it was last year, and a whole lot less affordable than it was before the pandemic. We're seeing prices come down in Florida, but you have to remember that Florida was gaining more and more value up until last year. So this is kind of an overdue correction. The rest of the nation, it's still prices going up, and that's amidst these high mortgage rates, but rents are coming down. So if you are on the verge of deciding whether to buy a home or to rent, at least you know that for the short term, your rents are probably going to get more affordable, not less affordable.
All of this considered, I mean, it's coming back to inventory, both on the existing side and on the new home side as well. And we're starting to see that the new home build outs get to some of the highest percentages, at least on a historical basis, of the overall inventory in market that's coming online here. And so what do you make of that dynamic that we're tracking?
So the places where rents are coming down, it is where inventory is going up. And some of that is coming from condos being converted into rentals. Some of that is coming from new construction. There's a lot of new construction in the South. In other places where there isn't new construction, where there aren't that many units to begin with, rents are still rising. So even though I said rents are coming down, it's not a guarantee. It does depend on where you are in the country.
Is there a silver lining to all of this?
Well, I think that the fact that so many voters care about housing makes it more likely that this issue is going to be addressed. President Biden has been talking about housing affordability on his campaigns. And at the local level, there has been progress with zoning reform, and that's in red states and in blue states. It's going to take time for more inventory to come online, for affordability to come down. But I think everybody is starting to recognize that adding to the supply is the only way to sustainably make housing more affordable.
Certainly. And then when we think about the number of people that are saying and making the decision now to say, all right, maybe we just purchase now and refinance later. Is that part of the home buying calculus for people who are willing to take on a mortgage rate at this level?
Well, if you're going to take on a mortgage, it's really important that you can afford it in the short term. You shouldn't bank on rates coming down as part of your financial plan, because they may not come down, or they may not come down as quickly as you were hoping. But I think for the most part, the people who are getting these adjustable rate mortgages, they can afford them. And it's more of a hope that rates will come down, or they'll be able to refinance, than something that they're really banking on.
Daryl Fairweather, who is the Redfin chief economist. Daryl, great to see you. Thanks for jumping on Yahoo Finance with us.
Thank you.
Appreciate it. Well, can you afford an expensive emergency? A lot of Americans cannot. We break down how you can build up your emergency fund so you can take on anything right after this quick break. Trading in shares of around 40 stocks was halted on Monday due to a technical glitch on the New York Stock Exchange. An NYSE spokesperson attributed the tech issue to the Securities Information Processor, aka the SIP, a machine that consolidates data like bids, prices, and trades into a single data feed. Now, the issue was fixed shortly before noon on Monday, and trading to the impacted stocks resumed. GameStop, AMC, Chipotle, and Berkshire Hathaway were all affected. The error caused Class A shares of Berkshire to plunge more than 99%, and trading was halted in what the NYSE classified as an LULD pause, or a limit up, limit down pause. But let's back it up here. What is a limit up, limit down, and how does a stock exchange even detect these kinds of issues? So let's break it down. In our ever-growing electronic world, there are three primary market guardrails to help prevent what exchanges deem unnecessary volatility in stocks. Now, the first is a market-wide circuit breaker. This halts all stocks when the market suffers excessive declines in one day. For example, if the S&P 500 falls 7% in a day, trading will stop for 15 minutes and then reopen. Now, there are three total thresholds where at level 3, if the S&P 500 falls 20% during the session, trading will be halted for the rest of the day. Now, the COVID pandemic gives us a good example of this. The markets saw 4 market-wide circuit breakers during the COVID-related sell-offs that took place in March of 2020. Now, the second guardrail for the markets is called limit up, limit down. This is designed to stop excess volatility in a single stock. Sudden price movements beyond certain price bands for a stock will then trigger a 15-second limit state where trading pauses, and if the stock comes back within the price band, then trading will resume. But if not, the stock is halted for 5 minutes. Now, the final guardrail here is clearly erroneous trades, which means there's an obvious error in terms of price, number of shares, or identification of a security. After an incident in January of 2023, more than 4,000 trades and over 250 stocks were canceled due to a tech issue. An investigation found the trades to be clearly erroneous. So once trades are found to have been made during an erroneous period, exchanges will move to bust or cancel those orders. Typically, there will also be a notification given as to whether the ruling is eligible for appeal. So after a trading halt, always check the trader alerts published by exchanges to know whether your attempted trade may have been canceled and whether it is eligible for an appeal. Well, switching gears here, times are tough for some Americans out there. Nearly half don't have $500 saved, according to a National True Cost of Living Coalition poll. And 1 in 5 Americans do not have an emergency fund, according to a Bankrate survey. To break down how you can prepare yourself for an emergency without sacrificing your everyday needs, we've got Monique White, Self-Financial Head of Community, here with us. Monique, great to have you back on the program with us. First and foremost, I mean, this is a jarring statistic. $500 in savings is what we're talking about here. What is the first step that many out there can potentially take just to establish some building blocks to establishing savings and putting together an emergency fund?
Yeah, that's a great question. You know, right now people are struggling due to the economic climate, rising housing costs, inflation, cost of living. And so people are trying to figure out how to save right now. The first thing that you can do is to just get started. Sit down, take a look at your budget, see what you can realistically start putting towards your savings, whether it's $10, $15. From there, you can start building a savings plan and start automating your savings, whether it's coming directly from your paycheck into your savings account, or you're having it go from your checking to your savings. The great thing about that is that you can tailor it to your paydays. Another method is to use alternative credit building accounts. So you can actually use that to build your savings and your credit at the same time. And that's something that Self offers.
What about for people who are living paycheck to paycheck right now? We hear about this all too often and how that's impacting the ability to save.
Right. So I think most financial professionals will tell consumers to save 3 to 6 months worth of living expenses, to save 20% of your income. But right now, that is just not the case. So it's it's time that we reshape the way that we view our savings. And it doesn't have to be this big catch-all scary account where you can only dip into it for these big emergencies. You can actually tailor your savings that fits your current financial situation. So you can have your standard emergency savings. Maybe instead of 3 to 6 months, look at how much you can afford for 1 month of living expenses and start from there. You can also have a sinking fund where you have regular occurrences throughout the year that tend to be a financial burden. So like your auto maintenance, registration, things like that. That's something that you can start saving for. Continue to save for retirement, whether it's through your employer or you can do it on your own through a Roth, or you can have aspirational savings, a down payment, a new car, a new home. These are all things that you can use as buckets for your savings, and then you can prioritize them accordingly.
How has the emergency fund evolved over the years? I mean, I think about when we were talking about this before, it seemed like $400 was too much for some people to have in an emergency fund. And now we're talking $500. I mean, clearly things are more expensive for sure, but how should people's emergency funds also kind of correlate and keep pace with the cost of living?
Yeah, in order to keep up with the cost of living, you do have to have a strong savings. If you're not able to increase your income or reduce some of your expenses, your savings account is the only way to keep up with those type of things. So it's important that you just take a look and be realistic and get started. Focus on maybe a month of living expenses instead of 3 to 6 months. Right now, it's all about doing what you can and creating a habit out of savings instead of it being this big account that seems unreachable and can be challenging for some people.
You've got a lot of fresh grads out there that are trying to figure out, okay, all right, I got to set up savings. I got to, pick out which retirement accounts I want to build out, and according to the new employers, options that I can opt into. All of these things considered, there's a lot being thrown at them right now. Where should they be kind of prioritizing the different accounts or different funds that they're setting up?
Yeah, so if your employer offers you a retirement match, definitely take advantage of that. Essentially, that's free money and you don't want to leave that on the table. So that's always a good starting point when it comes to your savings. You can also, I know we've been talking about savings, but your credit is also just as important. Sometimes it's a topic that's not in the forefront when it comes to your finances. And when you have a strong credit score, that is helpful to the health of your savings as well. A strong credit score can save you money in the long run when it comes to interest rates and being eligible for certain credit products and how much you have to put down for a down payment for a home or renting a house. So that's something that you should focus on, is having a strong credit score and then maybe prioritizing your retirement savings.
Monique White, Self Financial Head of Community. Monique, great to see you again. Thanks so much for joining.
Thank you for having me.
Certainly. Everyone, we've got much more wealth on the other side of this short break. You're watching Yahoo Finance. The NFL season may be a few months away from kickoff, but that doesn't mean teams aren't busy filling out their rosters, securing new sponsorships, or even bringing in some new owners and partners. Late last month, Atlanta Falcons owner Arthur Blank announced 4 new limited partners are joining his ownership group following approval from the NFL's full ownership. Joining me now is one of those limited partners, venture capitalist Rashawn Williams. Rashawn, great to see you. I mean, when I saw this come across, I was just like, let's go. Finally, it's about time we get more people who are getting a seat at the table and representative of so many of those players who are also involved in the league's operations on a day in, day out basis. What is the significance of this from your perspective? What comes next after this?
Well, Brad, first of all, it's great to see you. You know, I'm a huge fan, been following you for years and years, since visiting you on the New York Stock Exchange years ago.
Man.
Actually, during the Lyft IPO, I see you have the Lyft CEO coming up later this week for earnings. Look, I think Atlanta is a very special place, and I think the Falcons hold a very special place in the community for Atlanta, and I'm just appreciative of the opportunity that the organization and Arthur Blank gave to us. And we're just going to try to be the best LPs that we can possibly be and really give back to our community.
I mean, you are no stranger to kind of having a line of communication with so many of the athletes, either Falcons related or non-Falcons related, as you've been able to kind of work with them on their own investment and wealth building strategies. What are the considerations that they're making now differently about how to put their wealth to work and making sure that they're making money and they're growing out their wealth passively or actively?
Yeah, Brad, like you mentioned, the last 24 years, I've been focused on the first generation wealthy or the quick wealthy or the underserved community in terms of teaching financial literacy. All the things that I learned on Wall Street at Goldman Sachs and as a venture capitalist the last 24 years. And there are a few things that I've been teaching guys and mentoring them on. The most important concept that all athletes, NBA, MLB, or even someone that just exited a tech company or someone that just left Wall Street and has $5 million and has never done anything other than investment banking, right? But they're 34 years old. Very similar concepts. Number one, become the general manager of your own finances. One thing you'll notice that successful millionaires and billionaires do is they make their own investment decisions and they have a very qualified team around them. They don't have to be on the field running plays or calling plays, but they have to be the general manager, making sure they reward the people doing well and they kind of readjust their portfolio when things are not going well. That's one thing that we don't see, I would say, first generation or athletes, entertainers do that much. They usually hand that off to someone else who tells them, hey, trust me with your money, you just focus on that thing that you do. The second thing that you'll notice that is happening in this society now that wasn't happening 20 years ago is that athletes are finally figuring out, and entertainers, the wealthier you become, the less you need a financial advisor. This is something that billionaires have known for decades, and it's a very simple conversation. Look at the configuration of wealth for billionaires, and it's 90+% alternative investments. Businesses they own, real estate they own. Less than 10% of their portfolios are actually in stocks and bonds. Yes, that 10% represents $200 million, but it's still $2 billion in alternatives. So if you want to invest and grow your wealth like the wealthiest people in this country, you have to own private businesses. You have to own real estate. And then the last thing I'll say is the successful investors in this industry align themselves with financial coaches. Think of a financial coach as a person that's putting in more money than you, doing more due diligence than you, and has a track record of actually making money. That's the thing that you see that's happening with athletes and entertainers. They're aligning with VCs and private equity guys. They're not just getting deals from random people in the streets anymore. They're literally aligning themselves with the top 20 venture capital firms and getting in these deals and getting these exits.
You know, it's particularly interesting. You'd mentioned Lyft and us speaking back when that company was going public. And I think about the number of private companies that you've kind of baked into your investment thesis. What is maybe one of the most compelling theses that's out there right now, or themes that's even out there from your perspective?
Yeah, I would say industry-wide, everyone's been focused on cybersecurity, quantum protection, and quantum computing and AI for the last 5 years. It's becoming news headlines now with AI, especially because of all of the revenue growth you're seeing in that space and in that industry, which is driving the S&P. But in the private markets, we've been dealing with the AI and the quantum and the cyber for the last 5 to 7 years easily. So that's first and foremost. The second thing is within those industries, there's a large disparity between profitable late stage unicorns and unprofitable companies who still need funding every year in order to continue operations. And those companies that are not profitable are getting penalized with lower revenue multiples than the ones that are profitable because of where we are in the interest rate environment. So there are some buying opportunities if you can buy some of these companies, knowing that we're coming into a different cycle on the interest rate side and kind of ride that multiple expansion that a lot of investors like myself are taking advantage of.
A lot of people out there, they say, hey, I can't get into some of these private names and I have to wait for them to come public. Should people be jumping then at those companies when they do come public, or what's the best due diligence that they can employ once some of these businesses are finally able to make it into the equity markets?
Yeah, I hate to say it because it's a very risky market, but I highly recommend people just do index funds and not try to pick the winners. It's very difficult. Even the people who are paid to pick the winners still get it right only 30+% of the time, right? So if you are a retail investor or a part-time investor, I highly encourage you to do something like a QQQ if you want to capture a lot of the technology companies. It's been averaging 18% returns the last 5 years. It was up 54% last year. Obviously, it's more volatile. So in the down market, it'll underperform versus everyone else. But if you want to really capture a portfolio of technology companies that are public, I would highly recommend an index fund or mutual fund that represents tech. Now, in terms of picking your spots, look, if you can get into an IPO, which literally only the top investors in the country can really get into, or after it's free to trade that day, go for the biggest and the best. Go for the ones that are profitable right now. You'll get rewarded. And if you're feeling really adventurous, go for the ones that you think in the next few years have a path to profitability. But stick in those 3 industries, quantum, cybersecurity, and AI. And I think for the foreseeable future, you'll be fine.
The only thing that's adventurous is my golf game, Rashawn. Just lastly, while we do have you, the show is called Wealth. I got to know, for people who are trying to actively build wealth, what's your number one piece of advice?
The number one thing I would tell folks that I've actually never heard any financial advisors or financial gurus say anyone, so you're hearing it here first, Brad, because you're my guy, is this very simple question: what's your number? And what I mean by that is, what percentage return do you need on your investable assets for your net worth to double in the next 10 years? And if you wanted to expand on that, what percentage return do you need on a portion of your assets to live off of passive income? This is the problem where people who have $10 million and they retire at 35, if they're only getting 2% returns, but they need 10 in order to grow their net worth and live off passive income, there's a slow leak to the bottom. So you always start from what number do I need, not what number am I getting? What do I need? And then you align yourself with places that you can get those returns, whether it's stocks, real estate, private equity, venture capital, franchises, or bonds, or in this case, even money markets at 5%. So start out asking yourself, what is your number? What percentage return do you need? Not what I'm giving. And then you find the best team that can help you accomplish that goal.
Always a wealth of wisdom in your words. Rashawn Williams, thanks so much for joining us here on Yahoo Finance. Great to see you.
Good to see you.
Absolutely. Everyone, coming up, you won't be able to get loud on the floor or dance again at J-Lo's concert this summer because her tour is canceled. Love don't cost a thing, but that ticket did. We'll break down what you need to do when a concert gets canceled. That's next. The weakening consumer has hit some elements of the experience sector. After a huge year for concerts in 2023, with Taylor Swift and Beyonce having record-setting sales, artists are canceling shows left and right as consumers look for less expensive ways to spend the summer. Jennifer Lopez canceled her summer 2024 tour. She says to focus on family, but social media users, they speculate that low ticket sales could be the real motivation behind the decision. Joining me now with more on this, we've got our very own Rochelle Akufo covering all things the business of Jenny from the Block. Rochelle.
Indeed, it's been a tough block for her. I mean, we saw that Live Nation recently announced that J-Lo cancelled her summer tour. Now, when you think about this, she already rebranded this tour to tie it to her newest album, This Is Me Now, and her accompanying movies. And then it became a greatest hits tour and now reportedly cancelled, tied to some of these weak ticket sales and fans not really connecting with the new material, even before we heard about this full tour cancellation announcement. But she's not the only one. The Black Keys also shifted their strategy from these large stadium tours to some smaller venues as well. Plus, there's a laundry list of concerts and comeback tours for people to spend their money on. You've got Nicki Minaj, Bad Bunny, Olivia Rodrigo. Also, you got Green Day, Smashing Pumpkins, the Rolling Stones. I mean, there's too many things for us to spend our money on at the moment, and people are pulling back. So the timing for some of these big tours isn't great. As you mentioned, two massive tours already blew people's budgets, with Beyonce and Taylor Swift still ongoing as she continues the European leg of her tour as well. And it's no wonder that the Bureau of Labor Statistics reported that May's movie and concert admissions prices rose just 3.4% year over year through April. That's actually the lowest since 2021 and the second consecutive month of decline. So some pullback there, but perhaps we could also see it as a signal of a return to normalcy when it comes to some of these concert schedules after we saw just a massive amount of money being spent. But we also polled a sample of Yahoo Finance followers to see how they were feeling, and more than half, 54%, said they are not shelling out more than $50 for concert tickets, 34% willing to spend up to $150. I think people are just, they're tired. They're tired. The money's gone, Brad.
Who was that 3.5% that's like, yo, $400, just take it. It's yours. It's yours. Just put on a good show. I mean, if your favorite artist postpones or cancels a show and you spend $400, what do you do? How do you get your money back?
So it's a little bit tricky here. For postponed or rescheduled shows, it does get quite messy. It's easier to get updates from your direct ticketer, say your Ticketmaster. And of course, everyone's going to be calling, so perhaps use some of the chat bots and things like that. Ticket brokers, though, they do not have to refund tickets in those cases. Attorney Lisa Schaefer from FindLaw.com says the decision to refund the ticket price is in the hands of the artist, the team, the venue, or the promoter, and they can leave that open-ended so that if you're trying to get a refund on a date that they have in mind, if they never come up with a date, you can't get a refund. So that's when you should reach out to your credit card company as well to try and get a chargeback, to say you're unhappy with your purchase. Let them investigate. They'll give you a temporary credit, but they still might end up siding with the concert organizer. But when it comes to a full cancellation that's not your fault, those you can usually get full refunds for, Brad.
Wow. Okay, good details. Good to know, especially as we go into outdoor and outside season. Rochelle, thanks so much.
Yes, get ticket insurance. If anything else, get ticket insurance if you don't buy directly from a Ticketmaster. That will cover whether it's their cancellation or if you're sick or late or miss your flight or whatever the case may be.
Well, I'm usually late, so that will certainly come in handy. Thanks so much, Rochelle. Appreciate it. Let's do a quick check of the markets here as we are rounding out our show here on Wealth, taking a look at the Dow, the S&P 500, and the Nasdaq. We're lower across the board for all three major U.S. averages right now, fractional declines as they may be. That's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. You don't want to miss it.